S&P futures then are pretty flat, actually. The pound, not much change, actually. 125 is where we trade after that wage data we got for the UK ahead of the Bank of England. Tom, what do you see on futures?
Futures pointing up, particularly here in the UK. FTSE 100 futures looking to add 15 points. You're flat on the DAX. CAC current futures looking to add about 11 points up at 7,568.
So looking for some modest gains, perhaps some flat performance across some of these markets here in Europe today. Let's have a look at the start of the European trading session and what we get. As we've just been through, quite a big movement in FX markets to contend with. But this is the Spanish IBEX, down by 0.2%. The FTSE 100 up 0.1%. So a mixed picture straight out of the gates this morning. There's the dollar weakness I was referencing. Yen strength, part of that story, of course. A little bit of strength in the euro also coming into play there as well. Here's the sovereign bond story, and Mark was highlighting this to us at the end of the last hour, talking about what was going on with the treasuries market. We're seeing yields coming down. That seems to be something that the European markets have caught on to as well, and maybe even the UK wage data helping that along, that theme of lower yields. So the UK 2-year, you see at the top of that sovereign bond column. So we're seeing buying of those bonds and the yield coming down by 9.5 basis points. Back to equity markets and how they've opened up, pretty mixed, in fact. Then the French CAC aren't almost entirely flat then this morning. What do you see, Tom, on the sectors?
Yeah, it's a mixed picture once again across the 12 main sectors that we look at, and that lower yield environment is helpful, of course, for sectors including technology, autos, and you're seeing a lift there of around 0.2%. Tech is gaining just 0.1%, but of course lower yields is helpful for that sector as well. Other gains coming through for basic resources. Again, I flagged this given the upside we saw from iron ore and copper prices in the session today. So basic resources lifted as a sector. It was the biggest loser yesterday. That's playing into the FTSE 100. We're seeing gains of 0.3%, in line with what the futures were flagging. Personal consumption as a sector down 0.2%. You're seeing losses as well in healthcare. That's down 0.4%. And other gains coming through for the construction sector up 0.4%. So it's a mixed picture. I'm really focused on what's happening in terms of basic resources, health on the downside, tech getting a bit of a reprieve alongside autos. The DAX is currently adding 0.2%. In fact, that's not reflecting today's pricing. It also takes a bit more time, but the benchmark is flat now, 473. Gains coming through, though, here in the UK, FTSE 100 up 0.3%.
Yeah, absolutely. The DAX actually not open yet, as you rightly point out there, Tom. So waiting for that to open. Elsewhere, entirely flat on the stock 600. Let's get into a conversation with the Markets Today team. Sam Unstead joins us from the Markets Today blog, can take us through some of the stories that they're focused on. We've been through a few of these already. Let's go to the ECB story then, Sam, because interesting to see how what they're doing around their balance sheet and how that fits in with the rest of their policy. You know, we've seen a lot of tightening from the ECB. Now on pause, and attention turns to cutting next year. What they do with their balance sheet in the midst of all of that, really important.
Yeah, and actually what they do with their balance sheet in the midst of the bets on the ECB really moving faster than everywhere else. You know, at the moment they're pricing in a cut, you know, in the early part of next year. That doesn't, if that does prove to be true, and I would expect in their meeting this week, like other central banks, they may push back against that a little bit and kind of want to keep their options open as much as possible. But if that proves to be the case, they kind of will need to speed up, you know, winding down the QT and you know, easing policy there if they are indeed then to ease policy again with rate cuts next year.
Switching focus from the ECB data, the rental market here in the UK. It's been a painful couple of years for anyone renting, of course. Is that likely to change? How is that looking in 2024?
So we got a report out from Zoopla this morning that the rises in rent will slow, right? Now, is that great news? I'm not totally sure, because they're still going to go higher, right? Until there is a change in the supply-demand dynamic, and you know what you've had as interest rates have gone up, lots of landlords have sold out of the market. They tend to have interest-only loans, so the cost for them has gone up quite significantly. They're selling out, so the supply has gone down. Until you see that dynamic change, you're unlikely to see rents actually come down at any point. And at the moment, they're going to keep going up. And as you mentioned, Tom, over the last couple of years, they've gone up very significantly, particularly in London.
Yeah, interesting to see how that rental story rubs up against the sales story then. Let's talk about another UK theme that you've been covering. And this is some interesting research from one of our colleagues around British small firms and the extent to which they want to go through with investment plans with interest rates having been on the rise for so long now.
Yeah, this is a report from Sage, and it kind of shows you, I suppose it kind of shows you what you might expect from smaller businesses in particular. They're kind of retrenching a bit. They're focusing much more on their costs, trying to cut costs and therefore kind of keep margins at a reasonable level. Partly because I think they look into next year and are not seeing a particularly bright picture. So actually what you're likely to see with larger companies too, you know, anyone who thinks their growth may well suffer next year, costs is going to be the key thing that they're focused on.
Okay, Sam Mumstead from our Markets Today blog. Thank you. You can get more, of course, from Sam, the rest of the team on the front page of the UK website, or by typing TLIV Go on the terminal.
Here's what we're watching out for then today. At 10 a.m. UK time, we will get the German ZEW survey for December. How much are we seeing a bottoming out in sentiment around the German economy? That could be part of the conversation. Over to the US at 1:30 p.m. when we get the CPI data for the month of November. At 6 p.m. UK time, there'll be a 30-year US Treasury bond auction. And it is, of course, the final day of COP28. We'll be watching for any climate agreements coming out of Dubai. And agreement on that front does seem to be a little elusive, Tom. We are watching that closely, of course. The role that we're seeing being played by large oil producers, or the countries that represent large oil producers, and what that does to the wording of any final agreement, and whether that will be acceptable to European and other delegates that are more minded in a sort of tackling climate change direction. So that's worth thinking about. But plenty of data to focus on today.
Yeah, and that, by the way, is really significant in terms of investment flows around the world as well, and the phrasing and the terminology of that. But back to the UK story, and this is something, of course, we hit at the top of the 7 hour, was the wage data and the employment data out of the UK coming in slightly below the estimates. But you're seeing a marked move in UK government debt on the back of this, Anna. So 10 basis point move lower in yields at the front end, all the way through the curve until you get to the 10-year at 397 now, the 10-year. So comfortably below that 4% level. Again, a move of 10 basis points lower as markets reprice where the BOE goes on this slightly softer wage data.
Absolutely. So you're right to point out, because we had the 2-year move in the GMM, and as you say, down by more than 10 basis points now, but it is substantially across the curve, at least out to the 10, 30-year time horizon. So substantial moves really in bond markets this morning. Coming up on the programme, Hargreaves Lansdown leads losses on the stock 600. We will look at that particular stock and others on the move this morning. Joe Easton is back with us to talk us through the latest moves. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it, because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Welcome back. This is Markets Today. We are 9 minutes into our European trading day. We see European equity markets making modest gains this morning across European stocks. Now, Treasury yields and the dollar are lower today ahead of the US inflation data and meetings with major central banks that will give fresh clues about the likelihood of rate cuts next year. Asian shares have been broadly higher, with European stocks also just opening in the green. Joining us now is George Lagarius, who's chief economist at Mazars. Very nice to speak to you, George, and thanks for joining us. Let's start with your expectations about the global inflation story. We've seen, of course, inflation. We've seen disinflation in many developed markets, and we continue to see that. What are your expectations for when we start to really see the start of developed market rate cuts next year?
Well, my expectations are towards the end of next year. I think the deflation story might have been a little bit overplayed. Okay, right now we have oil nearly $70. We have China deflation, and China is really helping its economy to grow right now. So neither of these two factors, supply side factors, which are deflationary, may necessarily hold at their present levels into the beginning or the first half of next year. So we could see a resumption of energy prices. So I'll be a little bit skeptical. And central banks, they sort of lost their credibility as inflation fighters in 2021. It took a lot of hard work to regain that. It will be very difficult for them to risk it again.
Do you expect then, on that view, for Jay Powell to push back on the market pricing at that meeting on Wednesday?
I expect that from Jay Powell, absolutely, and I expect that from Andrew Bailey. Look, there is the additional problem. The more markets begin to price in rate cuts, the more yields fall. So the market is doing the rate cuts for them, and they're just not ready for that yet. So at the very least, they need to talk rates up, even if they don't do much about it right now.
And what is the order? What's going to be the order of things, George, in terms of which central banks cut first, and what's going to be crucial in that decision for you next year?
Yeah, well, asked me that question 2 weeks ago, and I was certain that the Fed would cut rates first and everybody else would follow. The OECD said as much as well a couple of weeks ago. The thing is that Germany is sort of having a Hindenburg moment right now. Okay, industrial growth is falling off a cliff, and they're way behind in developing new automobiles. So with that in mind, I'm not certain that the ECB will necessarily follow. But still, that's my base case. The ECB is much more conservative, plus its rates never really went as high as the American or the UK rates. So I'm still on the camp of the ECB follows rather than leads rate cuts. Having said that, I'm more interested in what they do with their balance sheet.
Okay, interesting. So the Hindenburg moment of Germany, consequential, of course, with the Eurozone. As you say, 4% is the base rate across the ECB and the Eurozone versus, 5.25% here in the UK and a similar level in the US. Talk to us then. 2.4% is the inflation picture as well in the Eurozone at the headline level. You talk about the balance sheet requirements of the ECB. How do they adjust to that, and how much more work is needed? How easy or not will it be to get back to target? We're only at 2.4% now. We're not far off that 2% target.
hence my scruples about when the ECB will cut, and I'm really interested to see what Lagarde says today. But look, I think for what it's worth, I think that the ECB, by the way, has been reducing its balance sheet at double the pace of the Fed, really. So at some point, they need to begin with that. They need to begin with reducing that pace of quantitative tightening, and then we can talk about interest rates. So at the very least, I'd expect them to say something like that today. It's going to be, I think, not today, obviously, on Thursday. Out of the three central banks, it's really the ECB that's garnering not just my attention, I think everybody's attention right now.
And what do you expect them to say around the balance sheet then, George, when it comes to the phasing out of that PEP crisis tool?
Yeah, well, that's the PEP reinvestments, the pandemic era asset purchases. This is the key, right? Whether they will stop, whether they will start trimming them or not, because the pandemic is over. It doesn't make any sense to keep it. But on the other hand, we do have a very slowing economy. And I'm sure Lagarde, who is pro-growth, she's not Jean-Claude Trichet, who made a fateful mistake back in 2011. She's very pro-growth, so I'm sure she will not be tempted to make the same mistake. That's why, again, I think it's a very fine balance the central bank is trying to cut. Yeah. I don't think they'll do much in terms of interest rates, but yeah.
How finely balanced is the BOE? Before we let you go, we're seeing gilt yields moving again, yields down between 9 and 10 basis points across the curve, softer wage inflation data. How balanced is it for the BOE? Where do you expect them to land?
Look, I think the BOE, for at least for now, they will keep a hawkish stance. Wage growth had slowed, but it's still much higher than everybody else's. And I think that is a key concern for them. Okay, wage growth in every economist's book is the thing that leads to headline inflation the most. So unless they see wage growth coming off materially, I'd expect them to remain more or less hawkish.
Okay, more or less hawkish for the BOE, but the ECB is the one that's really firmly in focus for George. George Ligarius, chief economist at Mazars, doing the round of central banks for us. We really appreciate it. And on the potential Hindenburg moment for the German economy. Thank you. Another story crossing the terminal right now, and this was a red head just a couple of minutes ago, and it comes back to the real estate story of China with Country Garden, once one of the biggest real estate developers in the country, still one of the biggest real estate developers. And the news line is this: the Chinese builder, of course, facing this liquidity crunch along with many of its counterparts, is likely to avoid its first default on yuan bonds after most holders of local notes, local debt, then agreed not to demand repayment this week. That is according to people familiar with the matter. So a bit of relief, at least on the margins, and at least temporarily, for Country Garden and the real estate sector of China that remains, of course, under significant pressure.
OK, let's get back to European corporates. Joe Easton is back with us with a briefing on what's on the move this morning. Joe.
So we've got lots of red on the screen at the moment. Firstly, Nokia coming down around another 2%, 1.4% at the moment. They are downgrading their margin forecast for the full year to around 13% from 14% previously. This follows them losing that massive contract to Ericsson from AT&T to upgrade all their wireless networks in the US. So today they're giving us an idea of the financial impact of that. So that one is coming down. Over in software, we had Oracle overnight in the US falling around 9%, following some weak sales growth. So we're seeing SAP in Germany coming down a little bit as well. But a couple of big decliners. This is breaking news out of the UK. The UK says that there are lawsuits against a couple of mobile phone network providers, including O2, which is owned by Telefonica in Spain, and BT as well. Now, the lawsuits are claiming that those companies have overcharged for some handsets. This is where you have a contract for your handset and you're supposed to have paid it off, but you continue to get charged. This is what the lawsuits are saying. And as such, we're seeing weakness across that sector in terms of the UK telecoms today. So worth keeping an eye on those ones. Some pretty big decliners for stocks that tend to be pretty steady in terms of Telefonica and also BT as well. There's a couple of other big movers in the UK that we had. I think you mentioned earlier Hargreaves Lansdown was one of the ones declining. There we go on the screen there, down 6%, and we're seeing AJ Bell, the big rival, down as much as 8% as well. Now this Also regulatory, the UK CMA announcing that they are examining how the money being held on these firms' cash balances are being used. So a lot of people that use Hargreaves and AJ Bell to trade and buy stocks and shares, they also leave a lot of cash into these funds, so it's a big interest rate boost for them, and they're supposed to hand a lot of that money back to clients, but they're saying in terms of the CMA that that is not happening as much as it should be. Those are under investigation according to the UK regulator, and big moves for both of them. Hargreaves was the worst performer on the stock 600 in early trading following that statement. AstraZeneca has done a bit of M&A. It's bought a vaccine maker. This is over in the US. It's about $1 billion deal. It's a respiratory vaccine now. They obviously pivoted towards cancer more, but they are doing more in those kind of respiratory illnesses. So that one is getting a bit of a boost today. That stock that they're buying is essentially going to rocket over in the US in early New York trading. So do keep an eye on that one. Unilever, now this is the greenwashing probe. This is the maker of Dettol and also lots of cleaning products. The company potentially not giving the most honest guidance on how environmentally friendly some of their products are. We're waiting to hear a statement from Unilever. Some claims that green leaves on some of their products is potentially a bit misleading according to the CMA over here. A couple of weeks before we all get those Lynx Africa Christmas sets as well. I'm sure I'll be getting a couple of those. Finally, just a couple of broker moves on the screen. Fluidra, Rockwell and Wärtsilä all downgraded, and Nordic Semi has a new CEO. All of those are declining.
Joe Easton, thank you very much indeed, of course, from our equity team. There's plenty more coming up. Stay with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back. This is Bloomberg Markets Today. Now, Britain's competition regulator says it's examining claims by the UK arm of Unilever about how green its products are. Let's get more with Bloomberg's Dasha Afansieva, who's been following the story. Dasha, what sort of green claims has Unilever been making, and what does the CMA say?
So the CMA hasn't given really particular examples, but it's things like claims on the recyclability. And I have had a look, and one of Unilever's products here, Sif, they say that on the top of the bottle, they say this bottle is 100% made out of 100% recycled plastic, and then made out of recycled plastic. And then lower down, they say 50% recycled plastic, but we're working towards 100%. And this is the sort of thing potentially that the CMA is looking at, not wanting to preempt the results of the investigation. Unilever says it is disappointed and surprised by the investigation, and that it's going to cooperate. But it says that it just gives consumers all the information they need.
Dasha, is Unilever likely to be one of only, or is the CMA? Do we know if the CMA is looking at other kind of domestic brands?
We don't know if the CMA is particularly looking at particular other brands, but we know that this is going to be part of their remit. And lawyers have actually for a few months been saying to me that this is something consumer goods groups need to be particularly aware of, because over recent years, through this process of premiumization, persuading consumers to pay more for everyday items, one of the things that helps companies do that is by saying that this product is green. And this is coming under increased scrutiny, not just in the UK, but also in Europe, where consumer rights groups have actually been filing complaints about companies making claims about recyclability, about how green they are, about the contents of their products.
Okay, Bloomberg's Dasha Afanasieva on that probe, or that investigation by the CMA into Unilever and the consequences. Thank you very much indeed. Now, to the tech space, and Google's legal defeat at the hands of Fortnite maker Epic Games threatens to break up an app store duopoly with Apple that generates close to $200 billion a year. The ruling, handed down by a San Francisco jury on Monday, is a blow, of course, to the two companies' business models. Could lead to the relaxation of App Store rules. For more, we're joined by Peter Elstrom, Bloomberg's executive editor for technology in Asia. How significant then, Peter, is this decision for Google?
Hi, yeah, this is a significant decision for Google, and it's also kind of a surprising decision. As you mentioned, these app stores generate a tremendous amount of money, $200 billion. The companies in many cases take fees of as much as 30% of what you buy through your smartphone. So this could affect hundreds of millions of people who are buying things through their smartphone at this point. It's surprising because Epic Games actually sued Apple and Google at the same time. We got the decision against Apple earlier, and Apple largely won that case for a number of reasons. Google, of course, lost in this particular case. So it's worth diving into the details of what exactly was different in the two cases. We found out in the Google investigation that Google actually treats a number of the companies that sell things through the App Store quite differently. They cut side deals with companies in order to lower these fees that are often 30%. So with Spotify, for example, the music service, they can largely bypass these fees. Netflix also got a pretty sweetheart deal as low as 10% in some cases. And Epic Games complained that it had to pay up to 30%. So that's a big deal for Google.
Important. Yeah, important to get that detail then. Bloomberg's Peter Elstrom in Tokyo. Thank you very much for breaking it down for us. Coming up, we'll be getting back to the UK macro story around wages. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation? When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. European stocks in the green ahead of today's US inflation report. The Fed gets set for its final policy decision of the year. UK wage growth slows at the sharpest pace in almost 2 years in another sign of a cooling economy. And Unilever shares edge lower as the company's UK arm becomes the latest to face a probe over potential greenwashing. So, Tom, European equity markets then trying to make some gains this morning, succeeding in the case of the London market, a little more modest elsewhere. But, of course, the big data point comes later.
It does indeed, of course, with US CPI coming out 1:30 p.m. UK time, expected to come in at 0% month on month. And despite the warnings we hear from our own guests, from those that Bloomberg News speaks to about the fact that maybe you're going to get some pushback from these central bank governors this week, whether it's the Fed or whether it's Christine Lagarde at the ECB or indeed Andrew Bailey at the BOE. Well, equity markets continue to grind higher, as Anna was saying, but bonds as well, money continuing to move into bonds. And really, for me, that is the asset class of the moment. And we'll get back to the details of that. The wage story in the UK is certainly central to what's happening in gilts today, with yields dropping about 10 basis points across the curve. Across your benchmark equity story, though, you are seeing those gains then of about 0.1%. So this is a fourth straight day of gains. We'll see if it holds through the end of the session and through that CPI print of the US later. The DAX adding 22 points. And by the way, the CAC Cajon of France getting to a record high so far in the session today. A record high for the CAC Cajon, adding to those gains. The FTSE 100 adding 30 points, up 0.4% at 7,575. And Basic Resources is part of the story there. As we flip the board and look at the 12 main sectors that we look at in this environment, energy is also a story. We've seen oil prices just edging up in the session today as well. Basic Resources was your biggest loser yesterday across your sectors. That has turned around in the session today, adding 0.5%. Iron ore prices are up, copper prices are up. We're looking at any statement that comes out from the Xinhua News Agency of China on the back of the Central Work and Economic Committee that is meeting in Beijing, and whether or not there is an emphasis on fiscal support for that economy in terms of 2024. And that, of course, will be consequential to the sector around Basic Resources. Energy also adding 0.2% on the back of slightly higher oil prices. Citi, though, saying that those cuts from OPEC Plus will need to be continued through 2024. In the red, financial services down 0.1%. Healthcare taking a little bit of a knock, but less of a selling pressure coming through than at the start of the session, coming down 0.2%. What else is jumping out? Technology up 0.6%. Certainly lower yields helps that sector. Across the benchmark then, modest gains of 10%. Continuing to grind higher, 4 straight days of gains, and the news coming through from France, of course, in terms of that record high here in the UK, the FTSE 100 closing to that 7,600 level, adding 0.4%. Anna.
Okay, yeah, so we'll keep an eye on the French market, set for a record close. Let's pivot, though, macro conversation to the UK. We've had wage data out this morning. UK wage growth has slowed at its sharpest pace in almost 2 years. A further sign that the labour market is cooling in response to a flagging economy. Average weekly earnings, including bonuses, rose by 7.3% in the 3 months to October from a year ago. Let's bring in Anna Andrade from Bloomberg Economics, who can deep dive into the UK story for us. Anna, good morning. So we've seen a drop in wage growth, but will it be enough? I mean, these are still elevated wage levels, aren't they?
Hi, good morning. So the good news coming from today's jobs market release, as you say, was the drop in wage growth, particularly in private sector. Now it dropped to 7.3%, which is still high. But if you look at the underlying basis, so the underlying pace of growth, which is a three-month annualized basis, then it did drop to 4% from 6% before. That's a measure that the BOE tracks, and that points to significant progress because it leaves it closer to the 3% that's consistent with the 2% target. Now, whether it's enough, we don't think so. I mean, the first one is because, as you say, it's still very high levels. The second is that looking at a broader range of metrics, including the decision maker panel survey that the BOE does track, wage growth has been incredibly sticky. And then the jobs market is still tight historically and from the BOE's perspective, because from the BOE's perspective, the 4.5% unemployment rate is the equilibrium unemployment rate. So anything below adds to inflation pressures. And, we're still stuck at an unemployment rate of 4.2% right now.
Anna, we have a chart that shows 2-year yields here in the UK near a 6-month low now. We're seeing that price action across gilts as money moves in and yields fall between 9 and 10 basis points across the curve. Again, this chart showing the UK 2-year yield near a 6-month low. Does the wage data change your forecasts and the team at Bloomberg Economics in terms of the long-term rate cut view for 2024 for the BOE?
No, not necessarily, because it's just a data point. I mean, there's a risk definitely, and we've got the wage print today was softer than we expected, the economists expected, and the BOE expected, probably, and the CPI data that we got for the past month was also softer. So there's a general risk that the disinflation progress, when it happens more strongly than we expected, and if that's the case, that's a risk to our review. But so far, we don't have enough data to kind of suggest that that's happening. So in our forecast, inflation will still remain very high. It will still be at 3% in the spring, and the BOE will kind of only be comfortable, we think, in cutting when it actually sees progress in inflation, and that's only likely to come in the summer. So we're still, for now, keeping our view that the June meetings to August meetings are kind of the first meetings when the BOE can start cutting.
Okay, so look to June to August for the BOE to make a move despite this slightly softer than expected wage data. Anna Andrade, always comprehensive, of course, on the data coming out of the UK and the implications for the central bank, the BOE. Thank you. Now let's get to some of the other top stories on the Bloomberg terminal this Tuesday. Bloomberg understands that Saudi Telecom is among suitors that have been studying a potential acquisition of Altice Portugal. This comes as the state-owned Middle Eastern carrier is looking to expand further in Europe. Other phone companies and buyout funds have also been evaluating Altice, which could be valued at around €7 billion.
Bloomberg has learned that Bank of America has promoted 334 of its employees to managing director, 8% fewer than last year's total. One source says the 4th year in a row, more than half of those elevated to senior roles are women or people of colour. Wall Street banks have pledged to improve diversity as competition for top talent heats up across the industry. And Goldman is reshuffling senior execs in its $110 billion private credit unit as it seeks to double the size of the business in the medium term. According to a memo seen by Bloomberg, the revamp will see Greg Olafsson become global head of private credit, moving from his current role as co-president of alternatives. James Reynolds will become the bank's global head of direct lending.
Now the clock is ticking for COP28 hosts, the UAE, to secure a final deal with less than 24 hours before the climate summit is due to end. A draft deal calls on countries to cut their consumption and production of fossil fuels. If adopted, it would be the first agreement specifically calling for reductions in oil and gas, but it does fall short of the complete phase out that many countries are pushing for. Let's get more then from Bloomberg's Jess Shankelman in Dubai, who's been covering much of this for us. Jess, what has been the response then to this draft deal?
There's not very many people happy with this text at all. Overnight, the UAE presidency got feedback from countries who really do, as you say, want that phase-out language in the text. We've just heard that the presidency is going to be producing a new text today. We think that's going to be much later today in Dubai, probably, well, not before 6 p.m. So that means for us journalists here and for negotiators, we're going to be have another whole day of waiting to see what language they're going to propose.
Okay, so we wait for that new text then, Jess, this information, as you say, just coming out now. What are the chances then of Saudi Arabia and other oil producers agreeing to any text that, if it's been revised, is more agreeable to Europe and the rest? I mean, can we get on the same page here?
Anna, this is my 6th COP now, and I have a real sense that we're heading for a big showdown, and I think there's a possibility that this COP could end in failure, because there's a lot of countries, more than just Saudi, we're hearing there's about 18 countries who are strongly opposed to any phase-out, phase-down language. For example, the Nigerian Environment Minister was just telling my colleague, Laura Milan, that fossil fuels are the lifeblood of their economy. They cannot agree to phasing down what is keeping their economy alive. And then you have countries, you have the small island nations who are always pushing for strong action, but you also have the EU, the UK saying they want to have a phase out of fossil fuels, and they want a time in there. They don't want any kind of agreement to be phasing out by 2050. That's too long away. They want to see 2030. And if some of those countries walk out of the talks, they're going to collapse.
Jess, thanks very much. Bloomberg's Jess Shankelman with some of the high-stakes negotiations still ongoing in Dubai. Coming up, we will be joined by Pierre Moscovici, the former French finance minister. He now heads the country's top court for auditing the use of public funds. We'll get his thoughts on EU fiscal reforms. They'll be in focus as we move towards the end of this week with EU leaders meeting, and the outlook for the French economy. That exclusive conversation is next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Welcome back. This is Markets Today. We are 43 minutes into the European trading day. You're seeing gains of, less than half of a % across the European benchmark. But the CAC 40 over in France is set for a record close, and it's to France where we go now with a broader view on what's happening in terms of Europe and its discussions and debate around the fiscal pact. EU leaders meet in Brussels later this week when it's expected that they will try to close a deal on new fiscal reforms. As usual in EU matters, the bloc's two biggest economies are key in striking a deal. During talks last week, the French and German finance ministers inched towards an agreement but were unable to resolve all of their differences. Very pleased to say we are now joined by Pierre Moscovici for an exclusive conversation, someone, of course, who's been on the ground and involved in many of these discussions in the past. He now heads up France's top court for auditing the use of public funds, previously, of course, served as the French finance minister. Monsieur Moscovici, thank you very much for joining us. From what you've heard, from what you've seen, we've been getting reports that they're 90% close to a deal, 91% close to a deal. It does ultimately come down to France and Germany. What is your sense from what you've heard, from what you've seen, as to whether or not this fiscal pact will strike the right balance and what it will do for the Eurozone economy in the years ahead?
Well, it's true that I have some experience of that kind of matter since I've been as well finance minister, but also EU commissioner in charge of managing the pact. I think we are very close to a deal. It was not doable last week in the ECOFIN and Eurogroup meeting, but there have been talks since then between the French and German finance ministries, and I think they are quite close now to a common solution, and we will have a deal by the end of the week, hopefully. I don't know the details, of course, but what I know is that the previous version of the pact needed to be reformed in order to be more transparent, less complex, and also less pro-cyclical than the previous one, which was a kind of a self-inflicted austerity pact. We need to re-establish the rules since we've unplugged them since the COVID crisis and also the health crisis, the energy crisis. We need rules in order to have a roadmap for our public finances, but we need to have also flexible, intelligent, and also nationally owned rules. That's what I hope from the reform. Anyhow, on 1st January 2024, there will be rules. I hope it won't be the ancient rules, but reformed rules.
Okay, so we look ahead when we see if we get anything reformed. You have in the past, Monsieur Moscovici, talked about large deficits and debt in France and talked about France as being part of the club of European countries with large deficits and debt. Are you still concerned about the scale of debts in France?
Well, I'm informed about it. When I look at the comparison between the various Eurozone countries, I see that France is now in the top 3 of the more indebted countries. You've got Italy, then Greece, then France. We have a public debt of some 110%, whilst the average in the Eurozone is at 91%. It has been increased during the COVID crisis and the Ukrainian crisis, and it's reducing too slowly. That's my message. But still, one thing I want to insist on is that I'm not concerned about the level of the debt itself. French debt is manageable. It's sustainable. It can be financed since the country is in quite good health, with a large market linked to Germany, and clearly at the heart of the Eurozone. So we don't have financing problems. But the main problem to me is that when you have too much public debt, you cannot reach the level of investment that is necessary in order to finance the fight against climate change, or digital transformation, or innovation. And these are challenges for a country like this one, which needs to be modernized. The more you are indebted, the less you can act efficiently. And I think we need to prevent that, and that's why I insist so much that the government reduces deficit and debt, and for that have a strong action on public expenditure, since our public expenditure level is also the highest in the Eurozone.
Okay, let me draw you out a little bit then on that, because you're kind of nodding to a potential policy prescription and drawing on your deep expertise then. How do you strike that balance? What would your policy prescription be that allows the economy of France to modernize whilst getting that overall debt load that, though you say it's sustainable, on a trajectory lower?
Well, we've got now a mountain of debt. We've got 3,000 billion debt. That's the stock. We reimburse each year some 84 billion in 2027 in order to finance our debt. And this is way too much. On the other side, we have a wall of investment to finance. We need to finance ecological transition. We need to finance digital transition. We need to finance our educational system, our hospitals, innovation and research, which need to be clearly strengthened. And if you want the wall to be built, you need to reduce the level of the mountain. And for doing that, you need to clearly reduce the level of public expenditure. And for that, to reform our public policies, some are inefficient or insufficiently efficient, and we need to make them more efficient and less costful. And that's clearly what is to be done, and that's why I advocate for public for spending reviews in France. So this is not a practice we use to mobilize. We need to do that much more now, and for the next budgets, it needs to be done.
Okay, so the need for public sector, or at least public spending reform in France. As you look to 2024, Monsieur Moscovici, do you think France avoids a recession, and should the ECB be thinking about cuts, and if so, when?
Well, first, I don't see France in recession in 2024. I would certainly agree with the consensus forecast. We'll have a moderate growth of something like, I don't know, 0.7, and hopefully a little bit more. This economy has proven to be resilient in the past. We are certainly in a better shape than other partners. I would quote Germany because, well, we have adapted, because we have modernized, because we've got some big firms. We are in a strong situation. We've got a strong internal market, a high level of consumption. We need to have a better performance on external trade. So I would say I'm optimistic moderately on France, moderately, because the overall context is what we all know, a slowdown in growth all over the world. But I think that our performance can be, I would say, in the highest level in the Eurozone, among the countries which resist the better to the recession. We won't have a recession in France, we will have a moderate growth.
Okay, so near the top of the table there. On another subject, Pierre, could I ask you about the presidency of Emmanuel Macron? He's clearly suffered a setback as lawmakers rejected his immigration bill. This is the most recent development, perhaps, in French politics. What do you think on the broader level? What does that tell us about his ability to deliver his political agenda?
Well, that's a specific part of the agenda. And, you know, in France, the government and the president don't have a majority in the assembly. But for the first time since he was re-elected 2 years ago, almost 2 years ago, all the oppositions from as well the right, the left, and the far right have, I wouldn't say united, but voted together against a text on migration. And that is a political event, and the president and the government will have to find a way in order to get this text voted, and in order also to get a majority for the rest of the legislature, which lasts until 2027. I wouldn't say that's a crisis, but certainly that's a new situation that needs to be addressed, since for the first time, again, all the oppositions voted together, whilst they are very different from their political origins. They don't create an alternative majority. So there is no alternative majority, but there needs to be some creative thinking in order to find a way out of that.
Pierre Moscovici, we really appreciate your time, appreciate your patience. Thank you. President of France's Court of Audit, and of course, former French Finance Minister. Thank you for your time. Plenty more coming up. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg. Let's talk about what's happening in these markets as we await the latest US inflation read. Bloomberg Markets reporter Justina Lee joins us now. Justina, good morning to you. So let's look ahead to the inflation print out of the US later. A lot at stake for the Fed as well.
Right, exactly. I mean, currently economists are expecting kind of another slowdown in year-on-year CPI figures. I mean, that's, of course, good news for the bond bulls, good news for everyone. And that's mainly driven by the lower energy prices. And I think, you know, the bond market at this point has rallied so much that it's, you know, if you look at what's kind of pricing into money markets, I mean, they're pricing in 1 percentage point of rate cuts by the end of next year. And so I think the question here is also, with expectations so high, are we going to see like the kind of numbers that warrant that much, you know, aggressive easing? And I think that really is the big question here.
And as we look ahead to the Fed then, of course, this all ties into the Fed and the decision on Wednesday. To what extent are you going to be focused on the dot plots? How important is that going to be? What are you going to be zeroing in on when it comes to the Fed?
Right, exactly. I think people are going to be looking at how many rate cuts the Fed officials themselves are projecting. And chances are that they're probably going to be fewer than what markets are currently projecting. And I think the big question here is, I mean, if you look at the job report last week, it's pretty clear that there isn't really, you know, substantive slowdown in the U.S. economy. I mean, surely it's slowing a little bit. So maybe there could be some rate cuts more because of the slowing inflation rather than, you know, slowing demand necessarily.
Okay, Justina Lee, of course, our Bloomberg Markets reporter on the preview for that CPI print out later today. And of course, the Fed, the money is moving into gilts, by the way, as we talk about lower yields on US Treasuries. Look at these gilt markets, pretty aggressive moves into UK debt yields down between 10 and 11 basis points across the curve on that softer inflation data, Anna.
Okay, that is it for markets today. You can get more insights from the team. The Bloomberg UK website will give you those, or go to TLIV Go to follow the blog. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Traders await U.S. inflation data out later today in meetings from major central banks for fresh clues on the chances of interest rate cuts next year. UK wage growth slows at the sharpest pace in almost 2 years, the latest sign that the labor market is cooling in response to a flagging economy. Plus, Epic defeat. Google loses an antitrust court fight with Fortnite maker Epic Games that may cost it billions of dollars in revenue and upend the mobile app market. So there's quite a lot going on. Let's first of all look at the European markets map. Now, this gives us a good indication of some of the fault lines, I guess, there are in the markets. We look at treasuries, we look at currencies. We also look at UK wage growth slowing. This is another further sign that the economy is cooling. But frankly, if you look at treasuries, they're gaining, the dollar's dropping. If you look at equities, they don't really know what to do ahead of the U.S. CPI data. Again, investors will scrutinize for any clues of the Fed's next move on interest rates. So investors watching the U.S. CPI print due today before the Fed then meets for the last time this year. Let's dive a little deeper into the markets with Aliki Rufiak, portfolio manager at Robeco, and Bloomberg's Justina Lee. So thank you both for joining us. Justina, kick us off here on what kind of importance CPI data has. I mean, it could really move treasuries and dollar.
Yeah, totally. I mean, right now, economists are expecting a slowdown in the year-on-year annual inflation rate. And that will be kind of another data point, kind of despite the jobs rate numbers last week, confirming that inflation is indeed slowing. But it's interesting because I think at this point, the bond market has baked in quite a lot of optimism about rate cuts next year. So it's not just about inflation slowing. It's also about, has the U.S. economy slowed enough to warrant as many rate cuts as markets are currently projecting?
Yeah, Aliki, if you look at some of the things that you like in general, I know you have an underweight in global equities. Does that depend on whether the Fed cuts?
Listen, we've seen interest rates, especially in the U.S., move significantly lower. Since the end of October, U.S. rates have moved, the 10-year has moved 70 basis points. So, of course, the discount rate had a positive effect on equities. But more from a technical standpoint as well, what we've seen is a lot of optimism in terms of the equity volatility dropping at very low levels for 2023 from peaks that were observed also in October. And what that meant is we have entered during the last leg of the year into an environment where volatility is more benign. This, of course, has supported systematic strategies, and some of the support that we've seen in equity market returns is coming from this part of the market. However, we've also seen on discretionary positioning quite a bit of optimism there. If we look at the latest surveys, these have pointed out towards quite bullish sentiment for discretionary investors.
Yeah.
And of course...
But Aliki, yeah, I was going to rudely jump in because you think central banks have paused, but you actually don't think that there are any imminent interest rate cuts.
Indeed. So we think that the environment is more tilting towards a pause. We think that a lot of uncertainty also priced in terms of the growth outlook for next year. What the market is pricing is a soft landing, and there are question marks whether this indeed is going to materialize. Of course, the rate cuts that we've also seen priced in are around 100 basis points for 2024. We think that these are overextended and potentially at 4.2%. The US 10-year rate is at the lower bound where we don't feel comfortable as well in terms of entering US duration position at these levels.
And Justine, I guess if there are interest rate cuts from the Fed, the million-dollar question is it to track inflation, or is it because they're really worried that they're going to see a recession, or we're already in a recession?
Right, exactly. And I think that's going to affect the number of rate cuts next year, right? I mean, it does seem, I guess, pretty clear at this point that inflation is probably on a downtrend. Of course, the question is, are we nearing that hump when you're trying to get it to the 2% figure? But I think at this point, like, if there are no more signs of demand itself slowing, as there doesn't seem to be from jobs data last week, then chances are that you're not going to get as aggressive easing as is currently kind of priced into money markets.
Aliki, when you look at some of the other things that we're watching out for, which is ECB, I know you also look at, the resilience of supply chains. We see a lot of onshoring, some money going into the U.S. Or how are you expecting the U.S. economy to behave longer term?
Definitely, this is also something that we are very closely watching because, of course, with the onshoring, you expect some of the production changes to take place in the US, and potentially this would be inflationary. So on one hand, we have inflation coming down. On the other hand, higher production costs potentially are going to lead to a stickier inflation in the US in the coming year. So we wouldn't be surprised if we see inflation moving up in 2024.
In terms of what you look at, Justina, I know there's a lot of talk about earnings and the earnings kind of depression that we've seen. Are markets now priced to perfection, or is there still, apart from central banks, is there anything else that will change their behavior in the next 12 months?
Yeah, it does feel a little bit like this, because one interesting trend in equity markets is that it's kind of really embraced this Goldilocks narrative where you have kind of the rate hike cycle over, but maybe the economy not slowing enough. So one interesting kind of rotation recently is that we've really seen a resurgence in small cap stocks, which kind of have been out of favor for a long time now. So I think this is a sign that investors are embracing kind of their risk appetite once more, and then they kind of see these kind of riskier players also benefiting from the current environment.
Aliki, how do you play China? I mean, the most important story of the day when it comes to China is Tom McKenzie sending me a story saying there are now more coffee shops actually in China than there are in the U.S. So that is kind of pause for thought. But how are you expecting policymakers to behave in China?
So we're expecting some fiscal stimulus to come out from the current discussions that are taking place in China. But we don't think that the fiscal stimulus would be substantial. So some numbers that have come out there is around 140 billion to support mostly the recovery in the Chinese economy going into 2024. We think, although, that the property market is still challenged and will remain challenged for the coming year, as defaults are likely to be the case there. So from the perspective more of our emerging market equity positioning, we do, however, favor more diversified emerging market equity exposure in our portfolios. And this is actually underpinned by three drivers. The first one is valuations. Valuations are very cheap, both in China, but also from an overall emerging market equity universe. We see these are trading now at 30% discount to developed markets. And more from a fundamental perspective, earnings for emerging markets are expected to be better for 2024. Projections are for earnings growth around the 20% mark. And finally, I think where we do find most of the value is in countries where policy is easing, as well as we've seen inflation rates coming down. For example, Brazil is one case, and where policymakers are cutting rates, which should be also supportive of equity returns for the coming year.
Yeah, and Justina, how do you look at China and the interplay between China, the U.S., and everything else?
Yeah, I mean, does it feel a little bit like China has structurally shifted to a different place? I mean, part of it is sort of geopolitical tensions being worse, and I think part of it is a lot of international investors don't even want to think about China anymore. And I think sort of the point that was raised earlier is pretty interesting, because currently it does seem like Chinese policymakers are considering more fiscal stimulus, but historically they've always been kind of slightly more against that. So it would be interesting to see out of this upcoming policy meeting, like how much have they shifted in terms of that stance?
All right, thank you both for joining us. Aliki Rufiak, their portfolio manager at Robeco, and Bloomberg's Justina Lee. Now, a couple of stocks that we're looking at pre-market. Alphabet, of course, losing this Google Play antitrust fight with Epic Games. Now, this has been in the works for quite some time. You can see pre-market Alphabet shares actually down 0.8%. Then Oracle is reporting some disappointing sales on slowing cloud momentum, and you can see Oracle down 8%. Coming up, we'll unpack the latest UK jobs data, and we'll also tell you what it means for the path to interest rates. So we'll try and make sense of it. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Wednesday, the Fed decides.
We're talking rates, we're talking inflation.
Without a recession, that's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
Now, UK wage growth has slowed at its sharpest pace in almost 2 years, a further sign that the labour market is cooling in response to a flagging economy. Now, average weekly earnings, excluding bonuses, rose 7.3% in the 3 months to October from a year ago. Now, for more on all of this, let's bring in Anna Andrade from Bloomberg Economics. Anna, great to have you on the program. So there has been a drop in wage growth. Is it enough?
Hi, good morning. So the good news coming out of today's labor market release is that drop in wage growth, more focused on the private sector. We saw it drop to 7.3% from 7.9%. More importantly, on an underlying basis, so if you look at the three-month annualized, which is kind of the metric that the BOE looks at, you do see private sector wage growth going to 4% from 6%. Now, 4%, it's closer to the 3% level that's consistent with the 2% inflation target. So overall, this print kind of, shows significant progress. Now, whether it will be enough, for now, we don't think so, because one, the level is still high. Two, we'll need to see kind of it being maintained. And at the same time, the jobs market is still very tight historically and from the BOE's perspective, because the BOE thinks that the unemployment rate is at 4.5%, and right now it's still below that. So it's still adding to inflationary pressures.
So, Anna, does this change the forecast on long-term rate cuts?
No, not right now. We still think that the BOE will want to see, because it's been so data dependent for the past hiking cycle, we still think it will want to see progress on the inflation data, and that in our forecast will kind of only come with the April CPI print. So, they will only get the April CPI print after the May meeting. So for us, something like the June meeting and August meetings are the kind of the earliest window for rate cuts. Though, this print did suggest that there's a general risk that the disinflation progress happens more strongly, and that's something that we'll need to, to continue to look at.
Thank you, Anna and Andrade there from Bloomberg Economics. Now, coming up, the threat of rebellion, a constitutional tug-of-war, and a crunch vote in the House of Commons. We'll bring you the very latest on Rishi Sunak's controversial plan to deport some asylum seekers to Rwanda. That's coming up next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the UK Parliament is set to vote over the coming hours on the government's latest latest changes to its plan to deport some asylum seekers to Rwanda. Now, some right-wing members of the Prime Minister's own Conservative Party say the deportation plan does not go far enough, adding to the risks of a parliamentary rebellion. Now let's bring in Bloomberg's Lizzie Burden. Lizzie, good morning. So the stakes are very high for the Prime Minister, but would he ever be replaced before an election?
Well, the truth is that even if this vote passes today, he'll only get a reprieve until January the 8th. So that same question will rear its ugly head again. And now Rishi Sunak is saying this vote today isn't a vote of confidence in his leadership. But there are people in his party, Conservative MPs, who say it is in all but name, because if he can't get through one of his top 5 priorities to stop the boats of illegal immigrants, then he can't govern effectively, or at least that's what Keir Starmer, the opposition Labour leader, is going to argue, at least. So if we look at the numbers of whether we can get this passed today, you mentioned the various factions that have been rebelling. The right-wing part of the party say that the changes they want are not just tweaks, they are much bigger than that, and that the bill would need to be retracted, amended and resubmitted. But the good news for Sunak is that the One Nation conference of MPs, the more moderate MPs, they've been told to vote for it, so that's about 100 of them. The price of that support, though, is that they don't want any more tweaks to the bill to the tough side. So we'll have to see how all the negotiations have been going when we get the vote, but there have been lots and lots of MPs going in and out of Downing Street this morning for breakfast, and Kitty Donaldson, our UK political editor, tells me that smoked salmon's on the menu. So very Labour's Keir Starmer.
When you look at the possible election coming up in the next 15 months, does it make a difference? Like, what will they vote on? So if he does get the Rwanda bill through, does it give him more of a chance to get up in the polls?
Certainly the right wing of the party thinks so. It's this argument that if you can't get through one of your top priorities, then how can you claim to be this Prime Minister who is effective? And that's the argument that they're making. They don't seem to care about the consequence of potentially gambling on whether there should be another leadership election before 2025, January 2025, the last date when they have to call this election. But the right wing, the more moderate wing of the party, trying to show stability, focus on the economy, it seems to be a difficult argument for Rishi Sunak to make at the moment.
So, Lizzie, when you look at the next 6 months, are there any, we don't know whether the election will be called in spring. We actually have no idea when he'll call it, whether it's in autumn, and there's pros and cons for both of them. Are there specific things that Labour's looking at to make sure that they consolidate that 20-poll lead?
Well, at the moment, it's really difficult, isn't it? Whenever you speak to a Labour minister, to get more details out of them about what exactly they want to do. But you can completely see the strategy here. If they commit to anything fiscally and the headroom situation changes, then they're going to be in a bind. But you can kind of see how they're already in a bind here, because they've made the front benchers plenty of spending commitments, but at the same time, they don't want to reverse the tax cuts that Jeremy Hunt announced in his autumn statement. They don't want to be the party of tax rises, but they also don't want to have to borrow more than they've already said that they would, because you've seen what happened in the markets to Liz Truss's unfunded tax cuts. So this is the point that the Conservatives are going to be making about Labour in the run-up to the election. But this is the beauty of being in opposition. You don't really have to give away the details until the manifesto time.
Yeah, as long as you hold on to that lead. Thank you, Lizzie Burden, there, our UK correspondent. Now, immigration reform is also a political headache for the French President Emmanuel Macron. Lawmakers have rejected his plan to overhaul immigration, a key part of his campaign agenda in 2022. It's a blow to the president's reform agenda that underscores his inability to build coalitions to pass key legislation. So let's go to over to Bloomberg's Caroline Conant in Paris. Caroline, like Sunak here in London, the issue is, of course, putting major pressure on Macron. So how significant is this defeat?
Francine, it is actually the first time that the lack of majority in Parliament for Emmanuel Macron translates into a law being rejected even before being debated, even before reaching the floor of the National Assembly. Every time before, even with the controversial pension reform earlier this year, they managed somehow to force it through. Not this time. They tried to please everyone with this immigration bill, and in the end, they pleased no one among the opposition. The bill included some measures to facilitate the expulsion of migrants, but at the same time, to make it easier for some illegal workers to get their legal status when they work in sectors where you have labor shortages, such as construction sector, domestic staff, or restaurants and hotels. That was a red line for the Republican opposition. That's something they were totally against. So what's next for Macron and this immigration bill? The Interior Minister, Gérald Darmanin, handed over his resignation last night, something that was refused by Emmanuel Macron, so he remains in place. He's going to have to make some new proposals over the next few days. One way would be to call early elections, but that is unlikely for Emmanuel Macron that this will lead to a bigger majority. Another way would, of course, would be to please the Republicans with some even tougher measures against immigration, like restricting access to health care for some of these illegal migrants. And finally, one of the last resort would be to call a referendum in spring of 2024, specifically on this immigration bill. But again, that is a very risky political move for Emmanuel Macron.
Caroline, thank you so much. Bloomberg's Caroline Conant there in Paris. Now to China, and China has the most branded coffee shops globally. It's overtaken the U.S. after a 58% boom over the last year. Now China has nearly 50,000 outlets, according to a report from the World Coffee Portal. There you go. Growth was fueled by delivery-focused chains, Luckin Coffee and Cotti Coffee. Together, they added more than 11,000 new stores. And a brewery is opening its doors in Abu Dhabi this month, becoming the first company to legally make alcohol in the region. Now, the restaurant and pub called Craft by Side Hustle was granted a license to sell beer on tap that's been brewed on premises. It's the latest in a series of moves loosening socially conservative laws in the UAE and the surrounding Gulf region. Coming up, with less than 24 hours until COP ends, the clock is ticking for negotiators to agree on a draft climate deal on fossil fuels. So we'll have a full roundup of negotiations next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Now, traders await U.S. inflation data out later today and meetings from major central banks for fresh clues on the chances of interest rate cuts next year. UK wage growth slows at the sharpest pace in almost 2 years, the latest sign that the labor market is cooling in response to a flagging economy. Plus, Epic defeat. Google loses an antitrust court fight with Fortnite maker Epic Games that may cost it billions of dollars in revenue and upend the mobile app market. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the clock is ticking down for COP negotiators who are examining a draft of climate deals to cut fossil fuel use and production to get close to net zero by 2050. The former U.S. Vice President and climate advocate Al Gore has slammed the draft text, saying it reads as if OPEC dictated word by word. Let's get more now from Bloomberg's Jess Schenkelman in Dubai, who's holding the fort and just really looks at this blow by blow to see what's in the final communique. So, Jess, good morning. Thank you so much for doing Oman's work there on the ground. What has the response been to the draft deal so far?
Well, Francine, this absolutely by no means is not the final communique. The presidency has just told us in the last hour that they are planning to produce a new text today because the last text that was produced last night was by no means satisfying any country, particularly blocs such as the EU, the UK, small island nations that want to see a phase out of fossil fuels that is going to be starting by the 2030s. The text that came last night just merely offered an option for countries to possibly reduce their use of fossil fuels and consumption of fossil fuels.
But so, Jess, what are the chances of Saudi Arabia and other major oil producers actually agreeing to the deal?
Francine, I'm not sure if anyone is going to agree to the deal right now. I think there's a real chance that these talks could end in collapse in the way that Copenhagen did in 2019 or in Madrid Copenhagen in 2009 and Madrid in 2019. I was just talking to Alden Meyer he's a think tank E3G. He's been to 27 of these 28 COPs, so I consider him a veteran of this, and asking him, is there a way forward? Is there a path to a deal on this? He said the strategy could be to try and isolate the Saudis, trying to get to a point where they have to agree to language on a phase down. But at the moment, we're nowhere near that. We've counted 18 countries that are opposed to that. Nigeria's environment minister just said this morning to my colleague Laura Milan that fossil fuels are the lifeblood of their economy, and they cannot agree to any text that would agree to phase down what is keeping them alive.
So, Jess, if the deal is agreed in its current form, which seems very, very unlikely, then what happens next? Like, if it doesn't get agreed, then what happens next? Is there a way of making up for these emissions with something else?
So the deal won't be agreed in its current form. I think there's enough countries that have said they would walk out of the talks as it stands. It would be too weak. So traditionally, the talks, this kind of multilateral process has been criticised because what happens is you get a lowest common denominator result. So the country that wants the least, in this case the fossil fuel producing nations, get what they want. But what we're seeing now is a real pushback from even the US, the EU want at least the language that we had in the Paris text, which we don't have right now.
Jess, thank you so much. Jess Schenkelman there with the very latest from COP28 in Dubai. Now, Britain's competition regulator says it's examining claims by the UK arm of Unilever about how green its products are. Now, let's get more from Bloomberg's Dasha Afanisava. Dasha, as always, thank you so much for joining. I mean, we're talking greenwashing. This is like a pretty, big accusation if it's true. So what sort of green claims has Unilever actually been making?
Hi. So the CMA hasn't actually pinpointed the exact claims it might have a problem with, but I had a quick look this morning, and Sif, for example, says the packaging is made from recycled plastic, and then you look lower down in the footnotes, and it actually says 50% recycled plastic, but we're working towards 100%. So it's that sort of thing. It's the sort of thing that helps Unilever differentiate its products and possibly even charge more for them.
So this feels like a very big deal for Unilever.
It's a big deal for Unilever in particular because for at least 2 CEO time spans, it's touted its purpose, its green credentials. The new CEO, Heinz Schumacher, has kind of moved away slightly from purpose and said that not every product needs to have a social purpose, but still being agenda setting on its green targets and environmental goals has been a core of its reputation.
Dasha, I mean, I guess the concern is that we don't really have proper regulation to tell us what's green, what's not. So, if they were, found guilty of greenwashing, who's it up to find them? I mean, do they get a fine, or is it just more of an impact on consumers saying, well, they're lying?
Well, they could get taken to court, and generally they'd have to, if they were found to be greenwashing, they'd have to commit to a different course of action, a set of undertakings. And I think it's worth pointing out that the EU is also looking at greenwashing legislation. So this is likely to affect not just Unilever, not just in the UK, but all consumer goods groups across the region.
So what does it mean for competitors? At this point, we don't actually know if they've done anything wrong.
We don't know if they've done anything wrong, and Unilever denies that it has and says that it's surprised and disappointed. But consumer goods companies across Europe are being scrutinized for this more heavily, particularly the claims of recyclability and whether contents is recycled already.
Dasha, thank you so much. Great update there from Dasha Afanisava with the very latest on Unilever. Coming up, Robin Grew, the first female chief executive of Man Group's 240-year history, tells us how the world's largest publicly traded hedge fund is navigating risk and higher rates. That's next, and this is Bloomberg.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg. Bloomberg Television, your global business authority.
Well, Europe's banks are set to enter next year with only slightly diminished capital cushions. Well, this suggests they can keep up the recent payout bonanza despite regulators ordering higher reserves. Now, for more on all of this, we're joined by Bloomberg's Nick Comforts in Frankfurt. Nick, good morning. So why were the buffers so strong?
Well, it's really down to higher interest rates. Banks are earning, minting money at the moment because they haven't had to pass on much of the cost of interest rates to depositors by giving them more interest. In the meantime, they're pocketing much of the profit. And so it's been a great year for European banks in terms of earnings. They've managed to set aside money, putting in their capital buffers, and it looks like they will be able to pay out a lot of that to shareholders next year as dividends and also potentially also share buybacks.
So will the benefits of higher rates actually dissipate for banks?
Yes, that's what's expected, and we are probably going to see banks have to pass on more of the benefit in terms of paying more money on deposits. So there might be a bit of competition heating up for deposits, but also, depositors will be leaving, shopping around for better deals if they don't get more interest from their banks. There's also the question of just how long that can play out, whether banks can counteract that, and whether they can build up other streams of revenue at the same time. But the party does look like it's going to be slowing down at least next year.
So, Nick, there's always, of course, a dark side of higher rates, which is companies to which banks, provide finance to going bust. Is there anything else that we should worry about?
Yes, exactly. That's the big question. What do higher rates mean as they filter through to companies and, also borrowers in general having to refinance at higher rates? Will they be able to afford that higher interest burden which they'll be facing? As one analyst put it recently, if you look, this has to be one of the best telegraphed potential downturns or recessions of all time. We've been speaking about it for so long. The regulators have been putting banks under pressure. So while, yes, there could be a spike in bad loans, you'd have to be a pretty dumb risk manager not to have had this on your agenda for the coming year.
Nick, thanks so much. Nick Comfort there in Frankfurt with the very latest. Now, oil has edged higher after an attack on a tanker in the Red Sea. The incident has raised fears of disruptions to shipping due to the Israel-Hamas war. The U.S. military says the vessel was struck by a missile from Houthi-controlled territory in Yemen. And President Biden has cautioned that U.S. public opinion in support of Israel in its war against Hamas could shift. That's as he seeks to balance his support for the country with limiting civilian casualties in Gaza. Now, the remark comes as the White House pushes Congress for a new Israel aid package. And geopolitical risk from the Middle East to Russia is putting increasing pressure on business leaders across the globe. It's a topic I discussed with Robin Grew, the chief executive of the world's biggest publicly traded hedge fund, Man Group. Now, she told me the uncertainty is making it more difficult to get a hand on what comes next.
Yes, that would be the shortest answer I could ever give. Yes, it is difficult. I think that if this year has taught us anything, it's that prediction is not our strongest suit, perhaps. And that isn't just in relation to markets, it's in relation to these big geopolitical events that we are still living with.
But it's quite incredible to think that we're in a better place than we thought. I feel like every 6 months, there's like the doom and gloom crew saying, this is it, interest rates have gone too much, we need to reevaluate what happens next. And yet, the economy holds.
Yeah, look at the US numbers, the job numbers. It's been the story of this year is, what, really? They're up again. I think that's right, but we are starting to see some dovish central bank messaging. But I think what's interesting is I am not a believer that necessarily we're going to see the number of cuts that are currently forecast by the economists of the world coming through 2024. I think when we talk about it, and when I talk about it, and we have this conversation about higher for longer, which I still say out loud, and then cross my fingers in some ways that maybe I'm going to be entirely wrong, but higher for longer. I think where the nuance is in that message is that What we're unlikely to see is 0%. We're probably unlikely to see 2%. We may see some 50 basis points adjustments, for sure. But I think what we have been signalled clearly from central banks is that they're not frightened of using policy to control inflation or to try and respond to inflation. And I think that's the messaging we should all kind of get used to. Last 10 years, 0% free money. Next 10 years, higher for longer, with that slight nuance in the way that I described.
But Robin, why do you feel, I mean, central banks are really at pains at reminding us that every couple of weeks, and I wonder whether it's, you know, the cost of money changes everything.
Yes.
And markets, hedge funds, investors haven't quite grappled with that.
I think that where they're grappling with it, or what they're challenged with, and it's the conversation I'm having with clients, is the what do we do now? How do we think about our portfolio construction? If we think asset holders did very well in the last 10 years, beta was good, private equity might have been more interesting, cost of money changes that, changes it in any way for multiples for companies, hence the beta argument being tricky, the private equity markets being tricky, because guess what, cost of money and leverage. So what clients are talking to us about, and is that portfolio construction piece. What do we do differently to navigate the markets that we are expecting to see or that we are seeing? How do we deal with that? And that isn't just a beta story, isn't just a passive story, isn't just a private equity story. There's this bit in between about active management, and how do they put that into their portfolio? How do they make that work?
Robin Grew also gave me her insights on central banks, inflation, how the firm is really moving forward on the consolidation and acquisitions front.
We have always said that we will grow the firm organically, and we will always look for acquisitions to increase our capability on content for clients. I think what's interesting, as we just did, we completed our acquisition in Q3 of this year with a private credit manager in the US in the middle markets. I think what's interesting is that the multiples look more interesting. I think we've been talking about consolidation, mind. We have been talking about consolidation since the GFC.
For a long time.
Since the GFC. I mean, this is one of those points I'm going to perhaps want to laugh about in a few years' time from now. But I actually think as we look at the barriers to entry in this space, if we look about the cost of running our businesses, if we think about the scale that we need to operate at, I think, and the multiples that we're starting to see coming down, I think this could be an interesting time for consolidation.
But why has it been a long time coming? Is it regulation, or there was just no appetite, or it just wasn't ripe?
I think when cash is free, it softens that. I think the moment where people need to deploy at scale in liquid markets has been something that's softened. If you look at the trend has been in passive, it's been in private equity. If you think about the number of assets that no longer sit in the public domain, that's been our themes over the last 10 years. I think when private equity doesn't have quite as much cash, when that raising is harder, when lending is harder, these opportunities for niche spaces and expertise to come about, and they want scale. They need to be able to operate at scale, and having an organization that can deliver the amount of scale we've put in play, the bit that perhaps is less sexy and exciting, but that infrastructure, the ability to take businesses and grow them, that's what we do.
Well, that's Robin Grew, Chief Executive of the investment management firm Man Group, speaking to me for an upcoming episode of Leaders with Lacqua. Now, coming up, Google loses an epic ruling in a suit brought by the makers of video game Fortnite. We'll discuss what it means for the future of the $200 billion app store market. That's next, and this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
Now, Citi's Institutional Clients Group chairman says the environment for M&A should start to get better in 2024 after a very muted year. Leon Calvaria told us about the state of investor appetite for deals. Take a listen.
The investor appetite is there, absolutely. They want to see the strategic rationale. They want to understand the time frame to close from a regulatory standpoint, because obviously if it takes 2 years, they have to factor that in from a present value standpoint. And then they want to see what the value enhancement is. So the investor reaction, I think, will continue to be something that everyone focuses in on. But so far, strategic transactions have done fine. And the issue has simply been long-term regulatory impact and how long will it take and what will be the legal issues to get from here to there. That's unchanged.
What about industry here? Because the other big elephant in the room we have not talked about is Occidental, Crown Rock, $10.8 billion deal. You're starting to watch mega deals back in the market. 2 of the top 3 deals this year so far have been mega deals in the energy industry.
Correct.
Is that what's going to drive M&A into 2024?
Well, I think the environment for M&A should start to get better here. We've obviously had a very muted year. It's been muted because of the uncertainty on the economy, uncertainty on interest rates, and uncertainty from a regulatory standpoint. Those hurdles are starting to go away. But, you still have a 10-year that has not yet gone down. It's not broken 4%. So financing remains somewhat expensive if people have to do it. But on the other hand, the equity markets, from my standpoint, are at highs. So the use of equity becomes very, very attractive. So I think you will see some more transactions that are large. There is no doubt that those discussions are taking place right now. And I think the boardrooms and chief executives are feeling more comfortable about an economic outlook and a pricing that they can effectively act on. So I think next year should be reasonable. And the other side of it will obviously be an IPO market whose opening, I think, continues to get delayed.
That was Citi's Institutional Clients Group Chairman Leon Calvaria speaking to Shonali Bazak. Now, Google down in pre-market trading. That's as it suffered legal defeat at the hands of Fortnite maker Epic Games. That threatens to break up an app store duopoly with Apple that generates close to $200 billion a year. Now, the ruling handed down by a San Francisco jury on Monday is a blow to the 2 companies' business models and could lead to the relaxation of App Store rules. Now, to dive deeper into this, let's bring Bloomberg's tech reporter, Mark Bergen. Mark, all right, let's speak in plain English. I mean, is this a disaster for Google and for users?
I don't know. I wouldn't say it's a disaster for Google. Certainly an unexpected blow. They're challenging this, right? Like, this is the model that has worked for them for over a decade, right? They provide the Android tools largely for free. That's given them, 85% of the smartphone world. And in exchange, every time an app makes us a single dollar, through the App Store, Google takes a 30% cut. They've lowered that cut after some pressure to around 15 for certain companies. We've been seeing this for years in countries like South Korea. They've actually changed that and added things like outside billing options. But this is the first time that Fortnite has the CEO Tim Sweeney has said, the victory is not the court case here. The victory is Google changing its business model.
So what does that mean for all app developers, and what does it actually mean for Google? I mean, I was surprised. If you look at pre-market, Google's down like 1%. So were they expecting it, or does it not really, hit their business model?
There was a $200 billion figure. A bulk of that is Apple. Apple is the premium smartphone king. It makes most of the money in the App Store world. Google has bigger penetration in markets like India and Indonesia, places where there's a wider distribution of users, but just a lot less money being exchanged. And for Google, this is a smaller part of their business in some ways, right? They don't even disclose the Play Store as a revenue, right? They're counting on search ads, counting on YouTube and cloud. So my guess, with shareholders of Alphabet and Google have seen this for a long time, right? When the EU brought its big charges years ago, that's a $5 billion fine, barely a blip, right? So Google is able to sort of keep steering its ship through these problems.
Mark, I saw Oracle was down like 8.9%, almost 9%. What are you mostly focused on? Like, what will 2024 bring for a lot of these companies?
We're still looking at regulation is a big question right now. Google has a much bigger regulatory hurdle, right? They're facing this Department of Justice case. The EU just ruled over the weekend on the Landmark AI Act. We're going to see kind of how that's actually being implemented. I think Google is paying a lot of attention to AI, obviously, and its competition with OpenAI and Microsoft. So I think will the European Union be the first among many nation states and geographies to legislate AI? I think that's the bigger question we're looking for.
Mark, thank you so much. Mark Bergen there, Bloomberg's tech reporter. Now, we'll do, of course, full-time analysis of the CPI data from the U.S. This is what asset classes are doing right now. We'll look at treasuries, the FTSE gaining some 0.7%. Now, up next, Bloomberg Brief. Danny Berger in London, Manus Cranney in New York, and this is Bloomberg. Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we're seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of a family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Countdown to a crucial U.S. inflation report as the Fed weighs its final policy decision of 2023. Epic defeat. Google loses an antitrust court battle that could upend the mobile app economy and put billions of dollars of revenue at risk. And on the last day of COP28, deep divisions brew as fossil fuels and oil edges higher on a tanker attack in the Red Sea. A very good morning. It looks as if there is a little bit of cheer in Germany. The ZEW survey of expectations rises to 23 from 13.8. So have we passed the low point? We know that we're in a quasi-recession, or that is the risk in Germany. So expectations, ZEW expectations at 12.8. Investor expectations rise to 12.8 from an estimate of 9.5. The current conditions, that comes in at negative 77 from negative 76. So these are the top headlines. These are the indices. DAX future up 0.25%. Yields are dropping in the UK. We've had shock information on wages. Yields are dropping in the US. Yields drop in Germany. But these numbers are a little bit better than the market had anticipated, with euro dollar trading higher. The euro up by 0.25%. So we have a status of fear and loathing, one could say, in the bond market as we wait for the big drop today, the CPI numbers. And the mood is the scale of disinflation, the impact. That's going to impact the narrative for rate cuts in 2024. So here's what we're expecting. A headline to be flat and plus 0.3%. Bonds in the US, let's have a look at those. We have bonds in the US dropping ever so slightly, waiting on those numbers. Energy prices tanked for 7 weeks in a row. And we'll talk more about this, Danny, in a moment. Near-term inflation expectations are the lowest since 2021. Check out the gilt market. We were down by 11 basis points at one juncture. As I said, wage growth, the sharpest drop in 2 years. And this shifts the narrative and the timing. Rates traders are shifting up the size and the timeline of cuts to 87 basis points for 2024. That was just 76 basis points before the number. Crude is up 0.4%. There's a tiny war premium creeping in. That tanker struck by missiles in the Red Sea. That's the Houthi-controlled territory near Yemen. So, Danny, that's the state of play. These bond markets globally are trading down in yield. Good morning, Ms. Berger.
Good morning, Mr. Cranny. Well, these equity markets are trading up in price. We're right now sitting at a 20-month high for the S&P 500. Will it continue with an action-packed week that starts with CPI later today? We also have Cathie Woods buying into more tech. She just bought more Microsoft and more Meta. Meanwhile, European stocks trading at a 22-month high. It's cheer across these global markets. The CAC Aron is just within a whisker of an all-time high. We do have Citi, though, saying that the Euro Stock 600, the overall benchmark, should also get to a record come next year. Finally, Manus, the Asia-Pacific Index is also up 0.5%, really just reflecting what we're seeing across markets. But the important thing for this latest index for Chinese equities is that economists are meeting, economic policy makers are meeting in China. What sort of stimulus might we get out of that? So while Asia waits for that, Manus, we know what the rest of the market is waiting for. It's today's CPI figures.
Yeah, it's almost like a drum roll. I mean, look, the headline, as I say, is going to come in at flat. The question is, what is the trajectory for disinflation, deflation narrative? Take a look at what came out from the New York Fed yesterday morning, just after we left here, which was the near-term inflation expectations. And this is a representation of it. You're looking at year-ahead inflation expectations declining for a second month. So you are just seeing the trajectory, the overall trajectory, certainly setting the stage, according to Bloomberg Economics, that if this data comes in line, Danny, we could see a little bit of a drop in rates, so to speak. But tech is dominating the agenda this morning, isn't it?
Yeah, it really is. We have the Fortnite maker Epic, Manus, Epic Games, which I'm going to bet you haven't played Fortnite either, because we know you haven't played any video games since Pong came out. Epic Games went head-to-head with yet another tech giant, and it's come out on top. Google lost an antitrust court fight that could end up costing the company billions of dollars, but also upending the app store industry. Joining us now on this is Bloomberg's Tom McKenzie. Tom, I'm curious about this, because didn't Epic also try to use the same argument against Apple and lost? Why did they succeed over Google?
They did. First off, I have Manus down as a Mario Kart Supremo, so that's the image I have.
I bet you'd be good at Mario Kart, actually.
He's
probably an aggressive driver.
Those tight corners. Yeah, you're absolutely right. Look, the difference was they went and they lost against Apple, right? They had one judge presiding over that case. This time it was a jury, and the jury actually got to look at the whole case and, of course, bring their own experience around the use of the App Store to bear, and the Google Play Store as well, of course. So this changes the dynamic in terms of Epic's fight. Clearly, they've been pushing for this. They've been fighting for this for over a decade. It's consequential because we're talking about almost more than, in fact, $200 billion of in-app purchases that could be affected. That's a forecast by 2025. And what the judgment has said is that this is a monopolistic behavior by Google. They had to make some changes around the billing system because these app developers have before and prior and up to this had to use essentially Google's billing system. Google takes a commission up to 30%. They've also said Google's got to stop doing these side deals with some of the big developers there that put the smaller developers arguably at a disadvantage. So significant changes. Google has said they'll appeal, but already the lawyers, the legal eagles that Bloomberg has been speaking to, have said the changes are likely to come already because Google and others like Apple are going to have to shift to insulate themselves from the legal risk around this.
Of course, this is a break-in in the dam of these two duopolistic. You two won't remember it, but it was actually table tennis. This is how far back it goes. One of the very first video games. There you go, sound effects and everything. There's Jonathan Farrell. He doesn't remember table tennis. He's far too young.
I feel like I'm playing it right now. So
the dominoes are beginning to fall. I love that line from Tim Sweeney, the CEO. The dominoes are beginning to fall. So we'll see where that comes.
Yeah.
Oracle is taking a pasting this morning, down over 8% when I last checked. And again, it's not that their cloud business isn't growing. It's just not growing fast enough. In other words, who's eating the pie? And obviously, Oracle are losing a portion of the growth pie in the cloud business.
Well, yeah, you're absolutely spot on in terms of the growth. They are still seeing growth, as you say, but it's that comparison effect. And this is the second straight quarter where that growth has slowed. So it's slowed. The most recent quarter, then, the print that we got through from 30% growth on a quarterly basis for the cloud part of the business to 25%. And that, as you say, Manus, is where the concern lies as they compete with the likes of Amazon, as they compete with the likes of Alphabet and Microsoft in the cloud business. They spent very heavily. The concern for investors is that is not yet paying off. But you listen to the chairman, of course, the founder, Larry Ellison. He says demand is over the moon. Executives at Oracle are confident that this will pay off. And in fact, they are building 100, just get this, 100 new data centers. Interestingly, executives also said they missed out on some revenues because of the shortage of chips that are used in these data centers. There is that supply chain constraint when it comes to these high-end processors. If that eases, those revenues could pick up as well.
And then elsewhere in this world, NVIDIA once again coming under pressure from the U.S. government. How is this different than the pressure that they've had for what feels like forever now.
Yeah, well, look, the restrictions keep being tightened from the US. We haven't had any immediate changes around that, but Raimondo, of course, who oversees this on commerce, has said that they will adjust those restrictions as they see fit. But she also said, essentially, we're working hand in glove with NVIDIA, but they're also clearly concerned. NVIDIA, on the back of the most recent restrictions, has adjusted then the chip designs that it ships into China to basically get them below the bar that they are legally able to do that. 3 different AI processors, and that's where Raimondo and her team are scrutinizing. Again, they say that NVIDIA have been a very good partner so far, but it just reminds us of the fact that the US are very concerned, particularly, of course, about dual-use chips that could end up in the arms of the People's Liberation Army, the PLA, and particularly when it comes to AI.
Yeah, interesting to have this, again, this dynamic of her saying we have a close working relationship with them, but coming after them in some ways, too. Tom, thank you very much. That's Tom McKenzie giving us the latest on tech. Manis, let's get to some of the other top stories that we're tracking on the terminal this morning. Country Garden, the distressed Chinese builder, is likely to avoid its first default on yuan bonds. Most holders of a local note agreed not to demand repayment this week.
Renault is selling around 5% of its stake in partner Nissan, offloading the stock as part of a share buyback by the Japanese car maker. The move follows last month's finalization of a plan for Renault to reduce its interest in Nissan.
And Hasbro will cut about 1,100 jobs due to slumping sales of toys and games during the holiday shopping season. Manis, there's some games you probably played, you know, Mr. Potato, Jenga, that I think you can get on board with.
Take your lead. I have absolutely no. I mean, the one thing in the world that just. No.
You've never played Jenga?
No, I don't think so.
Yeah, the thing with the blocks. We'll have to play it someday.
You can educate me. Maybe it's an American. Maybe it's an American thing.
Maybe.
Generational. The differential. It's a bit like it's a bit like the Bund Treasury gap, spread on this show. Let's talk about the CPI.
Bring it back to the markets.
Bring it back to the markets. CPI. Anybody ring a bell? It's expected to be flat on the headline, possibly giving the Fed the room. Will it really give the Fed the room to cut rates? We'll discuss that with the strategist from BlackRock. Finally in the seat and in the house, Kareem Chedid.
We're also going to be hearing, Manis, from Robin Grew. She's the first female CEO in Man Group's 240-year-old history. She tells us how the world's largest publicly traded hedge fund is navigating risk and higher rates.
I actually think as we look at the barriers to entry in this space, if we look about the cost of running our businesses, if we think about the scale that we need to operate at, I think, and the multiples that we're starting to see coming down, I think this could be an interesting time for consolidation.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Fed decides.
We're talking rates, we're talking inflation. Without a recession, that's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London. We're counting down to the CPI, and the market has already priced in 100 basis points of cuts for 2024 and awaits the Fed's summary of economic projections. Our next guest, BlackRock strategist Kareem Jedid, says this: loosening in financial conditions has contributed to broad re-risking recently, reflected in the ETP flow surges into credit, U.S. equities. And yet, we think this is a good opportunity to get granular in equities and fixed income through sectors and more targeted duration in our views in fixed income. Kareem, good to have you with us. So if we look at the backdrop to today, we've got a massive loosening of financial conditions, as loose as they were as early 2022. The market's primed for 100 basis points of cuts. Do you think the Fed has got to re-grasp the higher for longer versus the higher for shorter narrative that bond and equity markets are holding so dearly?
I do think that the Fed will be monitored tomorrow in terms of how much they will push back against this loosening in financial conditions that we've seen. But context is everything, because, as you said, the loosening in financial conditions is really important, and it's through this lens that we look at the surge that we've seen in high-yield flows. High-yield ETFs just had a record in November, and re-risking in fixed income and equities has been super clear. But at the same time, there is a lot of cash on the sidelines. You know, we're coming from record levels of cash, almost $8 trillion in money market funds. So that is the context against which we're seeing investors put risk to work, put money to work, but then monitoring tomorrow how much the Fed will push against the loosening.
Well, I was going to say, given that backdrop, will markets even care? Maybe a short-term reaction, but will markets even care if the Fed and others push back?
Well, it's going to be really key in the next couple of days, right? We're going to hear from the Fed, the BOE, the ECB. I think it differs from one to the other. If you look at the market pricing for 24, the BOE stands out as probably the least dovish in terms of how much the market is pricing cuts. It's only 2.5 cuts by end of next year compared to ECB 6, Fed 4 cuts. And so, you know, I think this is the environment to get tactical. So one area we're getting more tactical is thinking about duration opportunities in UK gilts, where the market hasn't reflected some of those moves yet. Right. And that's also something we see in the ETF flows. Even with the re-risking trend, it's not a buy everything, it's a get selective and buy where you think there's opportunity.
Right. Well, just on that, obviously, we've had the wage data from the UK this morning, and the rates market has shifted slightly from, 75 basis points of cuts next year to just over 86. But the UK is so far away from its inflation targets. This is the wage growth, Kareem, that we had this morning, the slowest in 2 years. And obviously the rates market reshifts. Do you want to be outright long duration in gilts, or do you want to play it as a spread relative to other markets?
I think a little bit of both. If you look at the curve in the UK, there's some opportunities coming up, for example, in the 15-year point, 10-year plus, where you're still getting above 4.2% yield. And simultaneously, as a relative spread, when you look at gilts versus EGBs, they've rallied, but they haven't rallied as much. So a bit of both. And I don't think that the BOE is particularly in a different spot in terms of how much, the growth fundamentals in the UK are weak. And as you said, with the wage growth chart, the great chart you just showed earlier, we are starting to see this inflation, accelerate. And so I don't think there's a reason to have conviction that the BOE would be more hawkish.
And what are the big risks for duration? Specifically, treasuries had been supply. Auctions that were poor led to sell-offs. We had an auction yesterday. It wasn't great, 3-year and 10-year. Treasuries rallied. We're going to get a 30-year auction today. Is the market over this? Is this no longer a concern, a a risk for duration selling off?
I don't think so. If you look at our outlook, which we published last week, and we highlighted a couple of things. We highlighted managing macro risks as well as steering portfolio outcomes. These are two of our themes. And with the macro risk, one of those risks is really to consider the supply in debt, in treasury debt. And I think investors still care. So we do expect term premium to continue to be a driver of steeper yield curves as we move forward from here. We're neutral now on duration when it comes to the 10-year bucket. We're overweight when it comes to the front end, but we're still underweight the long end.
I was very surprised when you said 2023 has been dominated by fixed income, but we haven't seen a level of re-risking that one might expect. So obviously, I don't know where you were in November, Karim. Maybe you were still à plage, but that kind of momentum. I mean, you talked about the liquidity that's on the sidelines, but you want to get more precise. We know you want to be long duration in specific areas, but I was surprised to see some of your equity sector calls, and you quite like a little bit of European banks, a bit of a brave trade, 40% discount to perhaps some of the peers. Talk us through the precision engineering within the equity allocation.
Sure, and I assure you I was in cold weather in November, but when we look but when we look at that precision landscape in equities, I think you need to follow two frameworks. One is a quality framework, so focusing on the areas of the stock market that you think will continue to give good quality fundamentals. So I'm looking free cash flow yield, for example. Investors will continue to reward those segments of the stock market that will generate high earnings. Look at the 2024 S&P earnings growth expectations at 11%. That's too high. So if the broad market will disappoint, quality earning sectors like tech will continue to be rewarded by shareholders. And then the value framework, that's the other framework where European banks come up. So it's really just going into segments of the stock market where you think that the valuations are simply too cheap. And that's the rationale behind this one.
Okay, Karim, gonna have to leave it there. Thank you so much for joining us this morning. That's BlackRock's Karim Chedid. All right, a quick check on bonds. Here's your setup going into the CPI decision, and it does seem to be a rally that's based off of what Karim was talking about, that UK data, the wages coming in the slowest growth in about 2 years. Gilt yields come in some 9 bips. They were something closer to 11 before, but the rest of this bond market is rallying. Ahead of the data, your 10-year just under 4.2%. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
You're watching Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. So, Manus, there's this global consulting firm called Mercer, and they've just put out a new survey of the top places to live, the most livable places. Let me give you the top 5.
Go on.
Geneva, Copenhagen, Auckland, Zurich, and Vienna. I think this is wrong. Most of these are cold and expensive, and I would not live there. I think something's wrong with this list.
Cold and expensive, and I can tell you, it's damned hard to get yourself a dinner in Zurich on a Sunday evening when, for 10 years, it was only probably in the past, post-pandemic, that they began to open restaurants on a Sunday evening. New York comes in at 40th. Yeah, it's true. You can't get strudel when you want. New York is 40th, but here, there's a reason why you're leaving home. London. Top the UK's entries at 45, and Aberdeen comes in at 49. Dubai, there's a bias in this report. Dubai is the highest ranking Middle Eastern city at 79th. I mean, this is just a lot of people who've never visited Dubai.
Well, okay, so like just looking at the London versus New York thing, I love both cities, very dear to my heart. But can you really argue that New York is more livable than London? I mean, you're crammed in, you're paying your firstborn child for rent. I don't know. It's a great city. I'm not saying it's a bad city. Please don't IB me that I hate New York. I love New York. But I don't know. Something's fishy here.
I'm just leaving the whole sort of the whole concept about New York and the expense of New York with you. I think I had to ring HR and go, what's all this tax? There's like 4 lines of tax on this payslip. And I'm going,
it's a joy.
I haven't seen that for 6 years. I don't know what that is. It's monster. And then there's the price of bagels. Yeah, I mean, I'll leave that thought with you.
Oh, the price of bagels. Yeah, that is weird. Look, I'm looking at the rest of this top 10 list. Dusseldorf, Sydney, Vancouver.
I'll see you in Dusseldorf.
Frankfurt. I mean, yeah, why not? Guess we're taking Bloomberg Brief on the road to Dusseldorf. We'll see you all there.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Countdown to a crucial U.S. inflation report as the Feds weigh its final policy decision of the year. An epic defeat. Google loses an antitrust court battle that could upend the mobile app economy and put billions of dollars of revenue at risk. And on the last day of COP28, deep divisions brew on fossil fuels as oil edges higher on a tanker attack in the Red Sea. It's another day of rallying for the S&P 500. At least futures are slightly higher, but we are trading at a 20-month high in this American equity index. Tech also gets another backing from Cathie Wood, who, by the way, I know everyone seems to love to be very critical of her, but she is beating the NASDAQ 100 this year. She just added more positions of Meta and Facebook. European stocks, those are trading at a 22-month high. But if you look under the hood, the CAC around is on track to close at a record high. That's all thanks to the luxury companies, which are rallying again today. Citi also says that they think that the European equity index is going to hit an all-time new high next year. Finally, MSCI Asia Pacific, that is up 0.5%. There is a meeting of economists, top economists in China, so we're looking out for stimulus clues as we're equally looking out for the CPI data today, Manus.
Absolutely. Well, the backdrop to that CPI data is, of course, the New York Fed inflation expectations, the lowest since 2021, Danny. And we've just had BlackRock with us. The flow of money, there's still more to come. $8 trillion on the sidelines can flow into risk assets. But if you look at the overall bond market complexion this morning, you've got declining yields in the United States and in the UK. Quite a dramatic drop in the UK, and that's where BlackRock want to be long. They want to be long duration on a tactical basis, something appealing in the 15-year sector for them in the UK. Wages come in less hot than expected, and the market shifts. It shifts its pricing on rate cuts in the United Kingdom. Here in the United States, we're already baked in with 100 basis points of cuts in the market. We'll talk to Mike McKee in just a moment as we wait for the CPI. Oil and energy has been coming down for 7 weeks. That's going to help the headline, excluding food and energy. We want to talk about the core and the super core. Oil is up 0.25%. You've got some tanker attacks in the Red Sea. That has caused the tiniest of war premium to come through on the oil market. We've had 7 weeks of losses. Again, it will come down to the next leg of demand, probably from China, that will reset the tone for the crude market. Citi are already sort of saying on crude, you're probably going to need to see OPEC Plus extend their cuts throughout next year. Danny, good morning. Quite a bullish call from BlackRock this morning on all assets, really.
Yeah, a bullish call, and that's maybe underscored by a credit investor survey that just came out from Bank of America. The title of which, Manus, I know you'll like this, is Death, Taxes, and Year-End Rallies. Credit investors think that it's going to keep rallying, but for Bank of America, that means any January rally would be short-lived, and the biggest fear for 2024 should be no surprise, a central bank policy error.
Well, error in the form of perhaps not holding on to the higher for longer narrative, because the trajectory of inflation in the UK is way above where the rates market is suggesting we're going to get rates cuts. But let's pivot back to the UK, because we're all eyes down for the US CPI print, 8:30 Eastern time. And the Fed meets for the last time this year. That is on the agenda. Let's get to Washington. We have our Bloomberg International Economics and Policy correspondent, Mike McKee. So, Mike, tell us then, you're in Washington, the Fed, are they going to be looking more at the loosening of financial conditions in their thinking, or is it going to be about the last print of CPI and core CPI that will drive the narrative?
Well, they're going to probably be looking ahead rather than looking at any of the backward-looking indicators. This CPI is probably going to be more important for the markets than for the Fed, in that the Fed has already told us that they're likely to leave rates unchanged. But this will set the expectations for what happens in 2024. Everyone expects it to go down. The Cleveland Fed puts out a CPI nowcast that is pretty accurate. It predicts what's going to happen with a remarkable degree of fidelity, and they're saying we're going to go down to a 3% rate, which is definitely in the ballpark of what the Fed is looking for, not quite there yet. And then overall, slow progress on the core, but some progress, down to 4% is the forecast. You look at what the Fed forecast back in September, and right now the economy is performing better in every category than they had forecast. So coming out of this, there's going to be some adjustments to what markets think the Fed is going to say about 2024, probably more than anything else.
I saw this great stat from Bloomberg Economics that in the U.S., the 48 lower states, there were 19 days in November that were warmer than the 30-year history. So it was unseasonably warm. You wouldn't know it by being in these studios because I am freezing right now, besides the point. How much of the headline figure is just going to be down to that, to warmer weather, to lower gasoline prices?
Well, lower gasoline prices are going to make a big difference. They're going to take a lot off the top of CPI, off of headline. It also may affect industrial production because people may not have needed to use heaters and definitely not using air conditioners. And then people do tend to go out and shop when the weather's better, so it may help retail sales. We're not sure whether retail sales, which we get on Thursday, is going to continue rising. But if prices keep going down, that should make Americans feel better about getting out and spending some money.
Well, we know that according to the theory, Americans are the last ones to stop spending, and they're already on the buy now, pay later. So let's push forward and say, look, if we do get a better headline, maybe an at-the-money headline and a slightly tighter core, does that then help the rates market justify 100 basis points of cuts? Or do you see the rates market then extending that and perhaps pushing the envelope, as they like to do, baying for further cuts over 100 basis points?
Well, if we get a surprise to the downside, then yes, they'll go overboard because that's what markets do. Anything that comes in on consensus is probably going to leave us about where we are. And of course, the thing with futures markets is they change all the time based on new information, and we'll get new information tomorrow afternoon from the Fed. So I wouldn't invest too much in the futures market reaction to CPI today, but we'll be looking at sticky inflation, things that might surprise and tell us that inflation could go back up again in coming months. If there's anything that sticks out there, that could affect what people think the Fed is going to do.
Can we go back to the consumer, Mike? Because we are going to get those retail figures out on Thursday. What's the expectation?
Well, the expectation is for continued growth, but at a slower pace, partly because Danny's still in London and hasn't come over here to do her Christmas shopping yet.
That's what's holding it back.
When you get here, things will get better. The question is kind of one of timing. Do Americans, did they spend early, as they did last year, or are they holding off for bargains if prices are coming down? Are they going to wait till the last minute? There's no thought that we're going to see any kind of record level of spend, but are people out of money? Doesn't appear to be that way yet. And especially with gasoline prices going down, they'll have more to spend in other places.
I suppose the summary of economic projections is going to be one way that the Fed perhaps, I say this phrase quite often, regrasp the narrative. They've not really controlled the narrative at all this year. The bond market has ultimately controlled the narrative. But in those summary of economic projections, Mike, will we really pay much attention to the dot plot?
Well, I don't know if you will, but the bond market sure will, because they're going to try to match it up.
Well, let's be frank. Let's be frank. The bond market hasn't. The bond market hasn't. That's why I asked the question.
Well, here's what they do. When the dot plot comes out, it's brand new, and that's their latest forecast, and everybody tries to match up with what the Fed says is going to happen. And then, as Jay Powell said at his last news conference, that forecast decays because they only make it once every 3 months, whereas the bond market is adjusting every second to the latest information that comes in. So they end up being sometimes far apart. The interesting thing here is that the Fed overestimated what inflation would be and unemployment would be at the end of this year. And so do they bring it down sharply? And then how does the market take that going forward?
Manus, you can't be anti-dot, to be clear. I mean, dots go, the best function on the Bloomberg terminal. That's heresy.
The bottom line is, as Mike says, that they come out once every 3 months. The bond market has pushed the Fed's verbal agenda on every occasion, and that you cannot disagree with.
It's true, but you're still going to get a million IBs with just dots go in the next 24 hours. Mike, thank you so much. We know you got a busy time there in D.C., so we'll let you go. Bloomberg's Michael McKee tracking all the data and the Fed decision. Now, to the world of hedge funds, Robin Grew is the first female CEO in Man Group's history. Grew sat down with Bloomberg's Francie Lacqua to discuss how she's navigating the uncertainty of the macro environment.
Yes, that would be the shortest answer I could ever give. Yes, it is difficult. I think that if this year has taught us anything, it's that prediction is not our strongest suit, perhaps. And that isn't just in relation to markets, it's in relation to these big geopolitical events that we are still living with.
But it's quite incredible to think that we're in a better place than we thought. I feel like every 6 months, there's like the doom and gloom crew saying, this is it, interest rates have gone too much, we need to reevaluate what happens next. And yet, the economy holds.
Yeah, look at the US numbers, the job numbers. I mean, it's been, the story of this year is, what, really? They're up again. I think that's right, but we are starting to see some dovish central bank messaging. But I think what's interesting is I am not a believer that necessarily we're going to see the number of cuts that are currently forecast by the economists of the world coming through 2024. I think when we talk about it, and when I talk about it, and we have this conversation about higher for longer, which I still say out loud, and then cross my fingers in some ways that maybe I'm going to be entirely wrong, but higher for longer. I think where the nuance is in that message is that what we're unlikely to see is 0%. We're probably unlikely to see 2%. We may see some 50 basis points adjustments, for sure. But I think what we have been signalled clearly from central banks is that they're not frightened of using policy to control inflation or to try and respond to inflation. And I think that's the messaging we should all kind of get used to. Last 10 years, 0% free money. Next 10 years, higher for longer, with that slight nuance in the way that I describe.
But Robin, why do you feel, I mean, central banks are really at pains at reminding us that every couple of weeks, and I wonder whether it's, the cost of money changes everything.
Yes.
And markets, hedge funds, investors haven't quite grappled with that.
I think that where they're grappling with it, or what they're challenged with, and it's the conversation I'm having with clients, is what do we do now? How do we think about our portfolio construction? If we think asset holders did very well in the last 10 years, beta was good, private equity might have been more interesting, cost of money changes that, changes it in any way for multiples for companies, hence the beta argument being tricky, the private equity markets being tricky, because guess what, cost of money and leverage. So what clients are talking to us about, and is that portfolio construction piece. What do we do differently to navigate the markets that we are expecting to see or that we are seeing? How do we deal with that? And that isn't just a beta story, isn't just a passive story, isn't just a private equity story. There's this bit in between about active management, and how do they put that into their portfolio? How do they make that work?
That was Robin Grew, CEO of Man Group, speaking to Francine Lacroix. And doubtful of the scale of rate cuts that the markets are pricing in. But we are on that trajectory. It is CPI day today. Equities are higher. Just had BlackRock on the show. They're very pro-risk. $8 trillion sitting on the sidelines. Needs to be deployed more judiciously. Dollar drops ever so slightly. Will you get a weaker print on the CPI that will embolden the rate cut narrative that is driving the bond market? 419 on 10s. From New York and London, good morning at 5:42 a.m. precisely.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's Bloomberg Brief from New York and London with me, Manus Cranny, and Danny Berger. It is the last day of COP28, and the world leaders are looking to strike a first-ever global agreement on cutting the use of fossil fuels. Saudi Arabia has been strongly opposed to the fossil fuel cuts. The Saudi Energy Minister, Prince Abdulaziz bin Salman, sat down with Bloomberg's Will Kennedy last week.
Those countries who really believe on phasing out and phasing down hydrocarbons, you should come out and put together a plan for how, starting 1st of January 2024, when are they going to freeze? Well, they should at least freeze their production by January 24, and also put together a plan for when that descendance or phasing out will happen.
Well, let's get more on COP28 with Bloomberg's Jess Shankelman. Jess, good to see you this afternoon. You're going to be there, I would imagine, late into the evening. Yesterday was the first time we had a reference to reducing the production and consumption of fossil fuels. Who shifted? And is that strong enough language for the many rather than the few? For example, Saudi Arabia.
Well, Manus, first of all, I would admire your optimism that this is the last day of COP. It is absolutely not, because we are expecting another text to come out tonight, and that will almost certainly not be the final text. So the negotiations are still very much up in the air. Who shifted on the text that came out last night? Well, it was very, very weak. So this text is more likely to satisfy the likes of Saudi Arabia. We're not clear if they would sign up to that. But even in that very weak state, it could possibly satisfy them by merely offering them countries the option to reduce the use of fossil fuels. As we know, other countries like countries in the EU, the UK, small island nations that are very vulnerable to the effects of climate change, they want to see much stronger language calling for a phase out or a phase down of fossil fuels.
Presumably, Jess, if they get that kind of language of talking about a phase out of fossil fuels, if Saudi already is weary of the deal in its current stage, well, what are the chances of having Saudi Arabia at the table and of course, other major oil producers agreeing to a deal at all?
That's the million-dollar question here. How could you in any way get Saudi, and it's not just Saudi. We've heard there's about 18 countries that are strongly opposed to this language. Just this morning, we heard the Environment Minister for Nigeria describing fossil fuels as the lifeblood of their economy, and they're not about to cut themselves off from that. So how is there a way to possibly get some of these countries over the line? So, for example, some of the African nations, could they be offered more money on adaptation, more money on mitigation, and by that I mean investing in green energy sources to try and offset fossil fuels, to try and convince them to come over to the side of more progressive countries. And in that situation, you could leave the Saudis isolated, which would put a huge amount of pressure on them to agree a text. That is possibly one way through.
But of course, I mean, if the Saudis are not there and they're not signed on, I mean, last year's COP was all about China and their reluctance. If you have China and the US, but you've got one of the biggest producers of fossil fuels in the world, Saudi Arabia, going head to head with the United States. Indeed, you know, if they're not there and if they're not signed up, it just obliterates the heft of COP. Jess, let's see. I hope you've got provisions. I hope you're ready there to hunker down for the evening. That's Jess Shankerman on location at COP28. Now, Danny, we've touched on this a couple of times this morning. The oil markets are a little bit better bid, but I'm really surprised at just the minutiae. We're back in the red now, and this is after having seen a small bid to the oil market, as we saw some attacks on a tanker in the Red Sea. And again, it's this battle royal, isn't it, between war premium, of which there is none, and of course the oversupply scenario in the market, and that's what's dominating the agenda, isn't it?
Right, and you point out to me that Citi has been saying that OPEC needs to maintain its oil cuts through 2024. It is that supply which is impacting the market. Again, despite, Manus, as you say, Houthi militants claiming a responsibility for attacking that ship in the Red Sea that was headed to Italy, but they claimed it was bound for Israel. Okay, we're going to set you up for the rest of the day. Coming up, we're going to have a look at some of the market-moving events to watch throughout your day on this CPI Tuesday.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, you know, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. U.S. CPI, the big one, it comes in at 8:30 a.m. Eastern, and we'll also get the results from a $21 billion U.S. 30-year Treasury bond auction at 1 p.m. Plus, we're also going to be hearing from ECB Governing Council member Francois Villeroy at 12 p.m. Eastern from Frankfurt. And OPEC's monthly oil report is also due out this morning. Manus, the one piece of data we've already got in hand, though, is UK wages coming in, showing the slowest growth in about 2 years, and that's having ramifications across this global bond market.
It is, and if you look at the rates market, I mean, the gilts are the tail that are wagging the bond market dog, so to speak, because 7%, just over 7% was the wages, the lowest in 2 years. And we've seen a shift in the rate cut narrative in the UK, 87 basis points for 2024. But it's so far away from the inflation target. But will it slow down more dramatically? Germany, the ZEW, Danny, we broke that at the start of the show. Investors' expectations rose. So are we past the worst in Germany? But of course, 6 rate cuts are in the pike for Europe next year. Is that a little bit too much? Ooh, bit rich?
Yeah, but, you know, considering the UK is far behind on that, we're just speaking with BlackRock, who says that he likes the idea of UK duration because that's where the opportunity is, considering cuts are priced in much later and much less. But while those markets are moving, Manus, we've also got some individual companies that are shaking things up.
We have indeed. Keep an eye on Alphabet. Okay, it loses its Google Play antitrust fight with Epic Games. This challenges, as the court sees it, the duopoly when it comes to charging your developers 30% to put their app on the App Store. The world is shifting, Danny Berger. It's changing.
Should we tell everyone you've also realized that you have played Jenga before?
I have played Jenga.
You might not have played video games.
Yeah, it took the floor. It took the gentleman that works with me every day here, Kareem, to come over and go, no, Manus, you have played Jenga. He said, this is it. Then he showed me Macy's lights last night at Christmas. We also sold the dog. These are the things that we do, really strategically important things in the commercial break. Dog, Jenga, and what the Macy's, Saks of Fifth Avenue lights.
It's like you've had a whole day in the space of just a couple minutes of a commercial break. Manus, hey, while we go to break, let's show everyone the price of Savax. I think I got that. It's at 48%. Yep, AstraZeneca, I don't think I did. AstraZeneca is going to buy the vaccine developer. It's a potential $1.1 billion deal, 43% premium to Monday's close. From brief to surveillance.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Company Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
The equity markets got very excited at the end of September and the beginning of October, thinking, you know what, the Fed is done. The Fed is engineering an economic slowdown. An economic slowdown impacts earnings.
We definitely are seeing higher interest rates bite in a more meaningful way.
Growth is likely to be a lot worse than it has been over this past year.
I don't think even in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P totally unchanged. In so many ways, the week begins in 2 hours and 30 minutes. US CPI just around the corner. Then it's on to the Federal Reserve tomorrow, and then it's on to retail sales. For me, for everyone around this table, the biggest story overnight, a toy maker cutting 20% of the staff, TK, 2 weeks before Christmas.
It's 2 weeks before Christmas, and it's about the new reality out there, and it does fold into all the economic data. It folds into the new reality of a real interest rate. There's structural issues with the toy industry, and that Bramwell's kids only want apps. They don't want toys. You know, Mom, we don't want toys. You know, how strange is that? My kids don't want toys. They just want apps or, cash for makeup. But maybe the Hasbro should go into the makeup business. But the answers are structural, but there's also this question of cyclical and the mystery of this holiday season.
Elisa, does it get any more bearish than this from Hasbro? This quote right here: the market headwinds we anticipated have proven to be stronger and more persistent than planned.
It doesn't get more bearish. The question just is, bearish for who? Is it just bearish for the toy industry, or is it bearish for the broader society, considering the fact that we are heading into Christmas time? I mean, that's kind of sad that people aren't buying toys, but I have to wonder whether it's just that people have so much clutter and they can't move out of their homes. They already have so much stuff that they need to get rid of. So I just wonder how much that's also the sort of hangover from the pandemic, when everyone bought as much that they could to try to occupy their toys.
The hangovers are public. $5 billion in revenue. 6,400 employees. This is a microcap by today's standards. The fact is there's a lot of other companies like this struggling. And again, I go back to there was free money to get along, and with this inflation report today, it's going to be an update on how free the free money is.
Well, never mind the handover. I think in many ways in the equity market we're still drunk. Year-end price targets on the S&P 500, Citi, 5,100, Oppenheimer, 5,200. What did we hear from Ed Yardeni yesterday? 6K.
Precisely 5,800. He rounds it up in the headline to 6,000 out 25 months. Consider this. We are 1% away from a Standard & Poor's 500 total return record high. We are at a Dow Jones industrial average total return record high, and there's people still telling me this is a bear market.
Andrew Hollenhorst, Citi, nails it. One challenge for the Federal Reserve, one question, one major decision for Chairman Powell, Bramo, whether to accept the easing of financial conditions since early November.
And that's really the key question. What's he going to do to push back? And I have to say that Steve Englander over at Standard Chartered came out with this, which I thought was fascinating. What is the language that the Fed could say that could torpedo market activity? A statement that cuts can come if inflation progress continues to be made would be a screaming endorsement of the easing in financial conditions. Expect a huge rally. If he goes the other way, expect stasis, because nobody believes that he's actually going to be hawkish. And that, I think, is the asymmetry.
I think the data is more important than the verbiage. And Chairman Powell's verbiage will be adjusted by what we see at 8:30 today.
England are expecting a friendly Chairman Powell, not validation of current market pricing, a friendly Chairman Powell. Here's your equity market price action. Here are the scores on the S&P. We look a little something like this, totally unchanged after 2 days of gains on the S&P. Yesterday, a day of gains on the S&P 500, even with some tech weakness. This morning, yields down again, Monday, then Tuesday. We're down about 4 or 5 basis points here, Lisa, 418.72.
What we're watching today, the main event, and as you said, the week starts in about 2.5 hours, 8:30 a.m. U.S. November CPI. All eyes are going to be on core. We expect basically no change, no increase in inflation month over month when it comes to the overall headline number. This is being driven by gasoline, by oil prices, and other types of commodities. The key is 4% is where all non-energy and food prices are stuck in terms of inflation, and that is concerning for the Fed. 1 p.m., the U.S. is selling $21 billion of 30-year bonds. You missed the auctions yesterday, John. I was trying to talk them up. Tom kept talking them down. They were interesting. They did tail, but they were not.
One was bad, right?
They both were not particularly exciting, but they didn't really have a huge impact on the market, which I thought was newsworthy in and of itself. 30-year auction should be more exciting considering the fact that last month...
We had a board. The Wall Street Journal did an article on the auctions. We featured it. Grandma was glowing.
And then also later today, Ukraine President Vladimir Zelensky
This is going well.
is in Washington, D.C. today. He's meeting with President Biden and others, kind of the last-ditch effort to try to get something. A lot of people are saying it's kind of futile, though.
I want to insert here quickly the Washington Post, Ellen Nakashima, with a devastating article on Chinese espionage this morning. That will be the talk of the day in the world of Anne-Marie Horton.
It's good to be back. It's good to be back. Keep it together, Bramo. AMH coming up a little bit later this morning. Let's kick off the market conversation. We can do that with Russ Kosterick, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, let's start with the data at 8:30 Eastern Time. What are you and the team looking for?
Good morning, Jonathan. I think we're going to be probably close to the consensus. Inflation is slowing, but it's slowed in an even pace. We saw that last week when we talked about non-farm payrolls and hourly earnings, that the economy is moderating, but it's not a straight line down. I think inflation is going to give the Fed the ability to go on pause. But again, the big question is, since the market's already discounted that, is when are they going to start cutting? There, we do think some of the expectations have gotten a bit too aggressive.
Are we, Russ Kosterick, finding bull market exuberance here? I mean, you've got such a balanced approach at BlackRock. And my answer is, to take it from Robert Shiller at Yale, is it an exuberant December? Are we there yet?
Well, there's been exuberance. I mean, in November alone, we were 10, 11% off of the October lows. Now, again, all that did is get you back to where you were in July. But I do think that the market is more nuanced than that. I mean, you clearly have had a handful of stocks that have led the market all year. They posted stellar gains. Their valuations are not cheap. But you go beyond that. You look at the other 493, and suddenly things look very different. You've got most of the sectors trading at or below their historical median. You leave the United States, you look at international markets, they're not nearly as expensive. So I don't think this is a bubble. I don't think we're seeing the irrational exuberance we all spoke about more than 25 years ago. But you do see a market that is now discounted a soft landing, which is very different than where we were back in March.
Then how do you allocate? I mean, with that very nice summer you gave us, and we're away from exuberance, and there's people that still think it's a bear market. How do you allocate out 6 months or 12 months?
So I think there are a couple things you can do. The first of which is, again, I do believe that there are opportunities in the equity market. So you have your equity exposure, but you're shifting it away from just a handful of companies, although I do think they still have a place in your portfolio, but it's more diversified. Emphasize quality, emphasize consistency in companies, because as the economy slows, those are the characteristics people tend to value. And then finally, and I think this is something we haven't spoken about in a long time, use carry, use income to drive return. You can build a 6-7% bond portfolio, something you've not been able to do in many, many years. That becomes a bigger part of return in an environment where equities have already run quite a bit this year.
So just to put the sort of figure on that, is it 60-40, more like 50-50, or is it more like 70-30 with a greater credit exposure?
I think it's probably still closer to 60-40, maybe 65-35. But what I think you're doing differently is where 10 years ago, you might have just had that slug of long treasury duration, which wasn't giving you a ton of yield, but was giving you a very good hedge. Today, that bond portfolio has got more credit in it. There's more spread product, more securitized, a bit of EM. It is a more diversified portfolio with a higher yield potential than you might have had 5 or 10 years ago.
Russ, can we just finish on looking ahead to the Federal Reserve tomorrow after we get this CPI print? When this comes out, we'll get the statement, we'll get the summary of economic projections. Can we go straight to the dots? And the 2024 dots specifically, at the moment it implies 1 cut. Most people assume it's going to come down maybe another 2 and imply 3. If it implies 3 cuts, based on where the market is pricing, how do you think we would take that tomorrow if we didn't fully validate market pricing but basically got the direction right?
I think the market will be okay with that because, again, there's been a gap between what the investor community is expecting, what the Fed is actually suggesting the dot plots for most of the year. That said, even if the Fed goes in that direction, I wouldn't take that as validation that the Fed is going to cut as aggressively in 2024 as the market is discounted today.
Russ, the 10-year inflation-adjusted yield, the real yield, one measure I have under 2%, 2.02%, opens this morning a 1.98. The recent low is 1.94. Where should that inflation-adjusted yield be given the soup of 2024?
I think it should be pretty close to where it is. We were just having this discussion a few days ago. I don't think it's crazy that you're going to go through 2024 and the 10-year yield is not going to be materially different than where it is today, both the nominal and the real. So I think we've actually priced in a reasonable scenario going out the next 6 to 12 months.
One thing that I was noting for Bank of America is that the most consensus theme right now is rate cuts next year. The most counter consensus right now is higher for longer. How much do you lean against the consensus, given the fact that you don't see the weakness that would necessarily cause the default cycle that would really disrupt some of the trades that you find most attractive?
I think we have to define what higher for longer is. If higher for longer is going to be higher than we had in the post-GFC environment, then I think yes. I don't think we're going to go back to that equilibrium, in part because it's not clear that inflation is going to go back to not only the level we saw in the post-GFC environment, but also the stability. Part of why yields remain so low and that term premium was so low for so long is there was no volatility to inflation. And that has changed. And while I think inflation and vol are moderating, I don't think we're going all the way back to where we were in 2019.
Inflation data 2 hours and 20 minutes away. Russ, thank you. Russ Kostrick there of BlackRock. Looking out for the economic data, 3-part story this week. Economic data, CPI, then on to the Federal Reserve, then after that, U.S. retail sales. TK, I know you're super focused on retail sales in America.
70% of the economy, and to me, and Gina Martin Adams, John, on Friday, I thought was absolutely brilliant. Don't forget the real economy. Are we doing well in the equity markets? Because of the real economy? Well, guess what? Retail sales is the nominal, not inflation-adjusted thermometer of that.
In just a moment, we'll catch up with Terry Haynes as well of Pangea Policy. We need to talk about the latest in Israel. The president hosted a reception yesterday evening for Hanukkah and saying this: we continue to provide military assistance until they get rid of Hamas, but we have to be careful. They have to be careful. The whole world's public opinion can shift overnight. We can't let that happen. The problem for the president, it's shifting domestically already in America. You go to a recent poll, Lisa, half of those surveyed by Gallup late last month said they approved of Israel's military action in Gaza. That's 45% of Americans said they disapproved. Now, within that, 63% of Democrats disapproved. That's the reality for this White House going into next year.
When I read that comment from President Biden, I wondered if he was talking to Israel or if he was talking to himself, because there is a sort of feeling that he's running out of time and goodwill within the Democratic Party. That's my sense.
I am absolutely fascinated how this ends, and that every other event we've had in the Eastern Mediterranean has been between two identifiable parties. Where's the other side in this debate? I don't see it. And we haven't even talked in days about the northern border of Israel and the threats there.
And then need to get to Ukraine as well, Tom.
Well, yeah.
Split in Washington over another war.
Well, the two wars are front and center here, but he's got another war, which is while you were out, John, the polls were pretty ugly. I mean, it's been 1 poll, 2 polls, 3 polls. He's got a war at home politically. His domestic, it's just not happening. Bidenomics is not working with the people.
Oh, it's not resonating at all, Tom. Had a decent payrolls report on Friday. At the surface, at the headline level, a decent payrolls report. What continues to confuse me, you get those kind of payrolls reports, you think back to the previous administration, there would have been a big ceremony a big news conference about it, Lisa. You would have seen the likes of Larry Kudlow on every single business network talking about it.
Yes.
And what do you get from this administration? You barely hear from Lael Brainerd on the economy.
She's been invisible. No, stop. She's been invisible.
Silent.
Invisible.
Absolutely invisible.
Huge
Where are they talking about these numbers? They're not at all.
Where's the chest thumping that can actually appeal to a broader swath of Americans? They're trying, but it isn't the same kind of, it's the best America you've ever seen, which is essentially what people seem to respond to.
There's some really talented people in that administration that you just do not hear from, which is just absolutely bizarre. On the economy in just a moment, and on markets too, Emily Rowland of John Hancock Investment Management in the next hour on Bloomberg TV. Your equity market, just about positive.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
We are thankful for these, our warriors, and of course, USA partners and European partners. We will continue to do this and to make our cities more secure. It's very important that also we had good dialogue, and we are thankful to IMF that you will support us financially. It's very important during this challenging period.
Difficult moment for that man and his country. That was the Ukraine President Volodymyr Zelensky making the rounds in Washington yesterday, meeting with Kristalina Georgieva of the IMF and U.S. Defense Secretary Lloyd Austin ahead of today's meeting with President Biden at the White House. More coverage on that in just a moment. Let's kick off with a price action on the S&P 500, just about positive on the S&P, going into U.S. CPI a little bit later this morning. That data just around the corner. Then on to the Federal Reserve, Chairman Powell at a news conference tomorrow, and then on to retail sales after that. Futures going absolutely nowhere. Yields coming in just a touch. We're down 4 basis points, 418.91, and the Euro, Tom, just in and around 108 here at 107.98.
Front and center, the wars of December in the Eastern Mediterranean and the war of Ukraine. John and Lisa want to dive into that, but I've got to get up to speed on one of the key stories of the morning to inflame the Beltway of Washington. Terry Haynes joins now, founder Pangea Policy. Terry, we want to get to what we saw from Mr. Zelensky yesterday, but I have to ask about the Ellen Nakashima Joseph Ben article in the Washington Post showing that Chinese espionage in America is far more tangible than we were led to believe, including in Hawaii and the Pacific Fleet. This is red meat for Republicans and for Democrats. How will your Washington respond?
Well, you're absolutely right, Tom, that it will be the talk of Washington today. And at the same time, anybody in the foreign policy community, already knows a lot of this, frankly. The foreign policy community, nobody expected China to stand down. In fact, if you read and listen to what the Chinese say, they continue to say and believe they feel threatened by United States activity in the Indo-Pacific and elsewhere. And they're going to do everything they can to make sure that they have the best idea of what's going on inside this country. Frankly, we're a lot easier to penetrate than they are. So, it shouldn't surprise anybody that they're doubling down.
To shift gears to Ukraine, Punchbowl put this out, that Vladimir Zelensky's visit to Washington, D.C. is largely futile. Do you agree?
No, I don't agree at all. I don't agree that it's. I also don't agree that it's any kind of game changer. One of the things Punchbowl says is that the connection lost. He's likely to find a difficult environment. Well, he's actually not a decision maker in this process. But what we have here is a situation where I think ultimately this gets done. I'm at about 60-40 that it does by the end of the calendar year. But it's going to have to happen if and when Biden and Democrats get serious about border. I've been preaching to people for a month that nothing happens on these aid packages without serious movement to improve border security. And now we're actually getting down to the situation where that needs to happen. Zelensky's plea will help, but until Biden and it can marshal enough Democrats to make some serious incursions and inroads on border security policy, it's not going to.
Terry, this is actually counter consensus, and I want to dig a little bit further because a lot of people think it's not going to get done. What could a feasible border policy look like the Democrats could sign off on and the Republicans would pass?
Well, there's going to have to be an awful lot of improvements. The Democrats say that H.R. 2 is not, which is the Republican wish list, legislation that was put in at the beginning of the year. H.R. 2 is not on the table for them. That means pretty much everything else is on the table, from catch and release policy to more physical and electronic security, right across the board. And they're going to have to engage on a lot of that stuff. Now, Biden, importantly, I think, really made a U-turn here by saying that the border situation is broken. That is directly in contrast with what his own vice president, his own Homeland Security secretary, and others have said. Other senior Democrats, including number 2 Durbin in the Senate, most recently have said that. He's going to have to turn the ship around pretty quickly. That said, this end of the year deadline, I think, is an artificial deadline that Biden himself put up. They've got a few weeks to do this if they actually put their shoulders to the wheel and do it.
Terry, I thought the last time you were on with us, and thank you for joining so often, you were stunning on disaffected Republicans. With the polling of the present president, what's the path or likelihood or probability of a Republican president, a Republican Senate, and a Republican House, even if so many of the GOP are disaffected?
I think that that scenario, kind of the Republican clean sweep, is a very low percentage shot. I'd give that probably 15-20% today. Trailing risk, but not much more. The reason doesn't have much to do with national Republican sentiment. It has everything to do with the small nature of the Republican majority in the House. There's only a few seats need to flip. And number one. Number two, a lot of those are in blue states, New York, for example. And Democrats are going to throw a lot of firepower at those. So, the likelihood that a few of those seats flip and the the House becomes nominally Democratic, I think is pretty good. The map is much better for Republicans in the Senate, so there's a greater likelihood that it goes Republican there. And in the presidential, one of the things that I said earlier last week was I think I think the Republican Party at least temporarily splits if there's a Trump candidacy, but at the same time, you know, there's so many disaffected Democrats that both of those circumstances together make the likelihood of a consequential third-party candidacy much greater than it normally would be.
Terry, let's finish on the economy if we can. Inflation is coming down based on incoming information. Jobs growth is still okay. Terry, this administration still wants to talk about Bidenomics, but Bidenomics seems to mean something very different to the electorate. Why is this not resonating?
It's not resonating because the case isn't being made, first of all. You know, I find that increasingly in politics these days is that, you know, people talk to themselves, but not to anybody else. There's very little convincing going on from anybody. Secondly, to your conversation before the break, there's very little energy in the executive here. The White House decided to glom onto Bidenomics as a message, which was already out there, as a message that they perhaps could make inroads with, and you know that's not working at all. And that narrative now is so entrenched after a year plus that it's going to be very, very difficult to make that go away. Bush 41 found this in early 1992 when Clinton was going on about it's the economy, stupid. We were already coming out of a recession, so the Bush people fooled themselves into thinking, well, you know, this is all transitory. This will go away. We'll be in much better shape for the general election. And boy, did that not happen. So they're in. This is an intransigent narrative at this point.
Got to fix it. Terry, thank you, sir. Terry Haynes there of Pangea Policy. It's kind of a head scratcher, TK. You've got these very sharp, credible people in the White House. I'm thinking of Jared Bernstein, an old friend of this program. TK, I'm thinking of Lael Brainerd, formerly of the Fed and now of the National Economic Council. Why aren't we hearing from them every single week?
The answer is we don't know. And with Ron Klain exiting, I think the smoothness of the machinery maybe is not what it was 2 years ago. But what can be said, I think, without question, is this is all going to get written about 4 years, 6 years, 8 years out.
The problem is, what is the message? Look at oil prices. They're near the lowest ever. And partly the reason why is because we're pumping record oil. Do they go there? You know, how
No,
close
they
can you
can't
get?
because it's against their script.
But to my point is, there are a lot of things that should make people feel a lot better.
Sure.
And you are seeing that in pockets. But you can't
Is there
really
a
come up
script?
with a cohesive message around that.
I absolutely love the crude production story. Republicans get to go around saying we're not pumping enough crude, even though it's at a record, and no one in the White House wants to correct them. Precisely for the point that you're making.
I'm going to sound like Scoop
Absolutely
Jackson.
bizarre.
Scoop
Bizarre.
Jackson 50 years ago. Is there script to be positive? That's a key thing.
From New York City this morning, good morning.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
What a big 48 hours coming up. CPI this morning, then on to the Federal Reserve tomorrow. Retail sales after that. Your equity market looks like this on the S&P 500. Totally unchanged after 2 days of gains on the NASDAQ, with positive by just 0.1%. Tech struggled yesterday. Tom, tech struggled and the S&P still did okay. Breadth improving.
Distinction, I don't have the math in front of me, but SPX went up, breadth improving, and all of the Magnificent Seven dipped. It's not that they cratered, they plunged, whatever, but you're right. There was a real statistical nuance yesterday to identify Beth, Uri, and Timmer at Fidelity leading the way on the chart showing the story.
Let's lead the way in the bond market. 2-year, 10-year, 30-year. Bramo shaping up as follows. The 2-year down over the last couple of days. We're down another 2 basis points on a 2-year this morning, 468.25.
And how much is this entirely responsible for the increase in breadth that we've seen in equity markets? I just want to point to that. The KBW index since October 20th, which is one of the tops in the benchmark yields, up 22% since then. Just to give you a sense of that, there was an auction. It didn't go that well, but it wasn't terrible. And then another one similar. So then people are basically saying this is stability, and we can come in and buy here.
Dumb question. Do you know when there's an auction who's buying?
That's something that people examine, and we can ask our next guest, because I'm sure that he has a lot of views on that. But there is this question around, is it international or increasingly domestic, particularly older people who can actually get income?
See how she looks at me when she says
I actually looked specifically at the camera to avoid just this comment.
It's just absolutely, she's just vicious.
Are you two done? What did I miss yesterday?
I'm taking off the rest of the year.
Fireworks, are you?
It was a domestic.
What's that? Good to be back. I think I've said that twice now. Not sure I meant it either time. Let's get to the foreign exchange market. The euro looks like this. The euro against the dollar, 107.98, positive here by 0.3%. Easy to forget, Lisa, there's an ECB meeting a little bit later this week.
Thursday, and people are looking for basically nothing. And yet this is, to me, the big consensus bet that sort of is under the covers a little bit, that the ECB is going to cut rates before what we see from the Fed. So is the Fed going to set the script, say something, and then the ECB will say, okay, we can do it now?
And then we've got parity calls over at BNY.
Exactly.
Morgan Stanley saying maybe we can get there as well next year, looking for that stronger dollar. Let's get you the top stories under surveillance this morning. US inflation data 2 hours away. The median estimate in our survey calling for a headline reading of 3.1%, down slightly from last month. Core inflation expected to rise 0.3%. Wall Street's biggest banks in consensus on that figure. TK, a year ago, November 2022, CPI had a 7 handle. We turned that around. I know the base effects kick in and all of that good stuff, but that's a very different story 12 months later.
I mentioned a couple days ago, Furman up at Harvard teaching Act 10, and you know, you can take I take a 3-month annualized. I take 3 months data and spread it out 12 months. But he has a wonderful matrix of summing up all sorts of annualized studies into a single message, if you will, and it still says disinflation.
Goods disinflation, even goods deflation.
David Rosenberg said yesterday,
economy.
service sector disinflation is starting to click in.
Well, the good side of things sets up the next story. Toy manufacturer Hasbro cutting close to 20% of its staff, citing slumping holiday sales. Lisa, analysts expecting the company's sales to decline 19% this quarter. Here's the quote from the CEO. Market headwinds have proven to be stronger and more persistent than planned.
I think your point is well taken, which is how much is this really the pandemic hangover and a normalization? I also think that especially if people can't move because of mortgage rates, the idea of limited space is leading to a lack of desire for clutter. I'm just saying personally, I've heard this also from other people. You don't want more stuff if you don't have more space. It's the bottom line. I'm sorry, this is personal, but it also is what I hear. It's also what I hear from others. Again, though, I wonder how much is the transformation to the computerization of our children versus the tangible.
The kids aren't getting toys this Christmas.
They're just getting apps.
Message received.
Apple
okay.
Cash.
Massive reality check, not for Casa Bramo, but for Ford and the EV push of this administration. Halving its production goals for its electric F-150 truck, citing slowing demand for battery-powered vehicles. The company scaling back spending on electric vehicles by $12 billion and downsizing its battery factory in Michigan. Ford saying, quote, "We will continue to match production to consumer demand." And right now, Tom, based on those production figures, that demand ain't there.
Yeah, I'm glad you bring it up. To me, it's a ginormous mystery of where will you be in 1 year. Ford's trading with a PE, and I get it that the fundamental analysis of autos, it's 6. Like 5 or 6, like an unimaginable number. The stock chart ain't so pretty, and this is a huge issue. What we saw was cost cutting a couple days ago. Your conversation with Mary Barra of GM. I mean, the basic idea they're rationalizing out. Everybody wants to do this, but
it's speed versus direction. Directionally, if this is the way the world's going, got it. Okay, this is the way policymakers want to push us. Absolutely, got it. Okay, but speed. Bramo, are we moving too quickly based on the lack of demand that these big auto manufacturers are finding out about, which is Ford, GM, and all the rest?
And John Lawler of Ford, the CFO, did say that they're actually pushing out their target and lowering their expected adoption. But how much of this is really due to the infrastructure, the charging networks that people need to have developed before they go out and invest in a truck like this?
Into the economic data we go, and we'll have many voices for you, but this is absolutely definitive, and it's time for Global Wall Street to stop and listen to Anthony Crescenzi, to say he's market strategist, portfolio manager at a West Coast shop called PIMCO, barely describes his authority on short-term rates and how they redound to the Fed out the yield curve. Tony, thank you so much for joining Surveillance. I'm going to cut to the chase. The real yield, the inflation-adjusted yield, negative, way out above 2. It's come back. It's 2%. Where is that yield, the inflation-adjusted yield, in 1 year?
It's difficult to say, but it's likely to stay lofty, but it'll probably come down. And the central argument for that is the Federal Reserve. One should have confidence in the institution, that is, in its ability to foster price stability. It may be difficult to get to 2%, which is its inflation target. You know, we see today inflation over 4%, and it's been there for some time, and it peaked in the 6s, hit 9% for the overall level. But the Federal Reserve has a sufficient arsenal to bring the inflation rate down, and so one has to believe in its ability. Now, fostering price stability is different than getting to that 2.0 in the sense that the different definitions of price stability. Some could say it's 2.0%, but Alan Greenspan, former Fed chair way back, would say that price stability is achieved when price levels cease to be a factor in decision-making for households and businesses. That's likely to be the case before long. We see the inflation rate continuing to move down in 2024.
But the key thing here to the real economy is the new positive interest rate is tangible sector by sector through the Standard & Poor's 500. Are we going to, you know, Jardini's calling this an equity bull market, a roaring 2020s. Is this a real economy that can withstand this new interest rate regime, this post-pandemic regime?
Well, yields today are attractive relative to history. Today's yields doubled last decade's average. It's higher than the 20, 30, and almost near the 40-year average period that includes higher interest rates. It's attractive relative to expected inflation and expected volatility. The economy can handle it to some extent, but it can't in one major way. And this you see playing out in government bond markets. Think the UK in 2022. Prime Minister Truss suggested lowering taxes without giving a solution for paying for the increased indebtedness. The bond market pushed back violently. The yield on the 10-year gilt, as it's called, the government bond there, rose 150 basis points rapidly. You could say the bond market vigilantes came out and disciplined the fiscal authorities, and Prime Minister Truss was ousted. I like to call it, because I wrote a book about this idea, a Keynesian endpoint. Keynesian endpoint where we reach practical limits to the use of debt.
No, that's where the Dodgers buy Ohtani for more money than God. That's a Keynesian endpoint.
So the world is seeing that. So the high levels of debt do make it more challenging for nations to have high service costs. And here's one idea, what I call the read my lips moment ahead for perhaps the United States and other nations. Read my lips for George Bush, 1988, in a speech written by Peggy Noonan, Ronald Reagan's famous speechwriter. At the convention, he said, read my lips, no new taxes. He had to break the pledge 2 years later because the interest on the debt rose to 3.2% of GDP, which was a record that still stands. In a few years, we'll breach that. Politicians like Bill Clinton and his Treasury Secretary Robert Rubin solved the problem. We eventually had budget surpluses, but Washington doesn't seem to be the kind of place these days for those types of solutions.
As an investor, Russ Kostridge said that he's liking credit as a possible greater component of the 60-40 or maybe 65-35, that credit is offering sometimes a more attractive proposition, both from the fundamentals as well as the yield, the government debt. Do you agree?
In general, I mean, historically, if you look back, it's better to have some overweight to credit than not. We'd suggest an investor needn't reach very far for good yields in terms of risk-adjusted yields because yields are higher. We do think that this is total return time. This was a year for clipping coupons in, let's say, the Bloomberg aggregate, the high-quality bonds, but next year is more likely to be total return time. What we've seen historically since 1978, core bonds, those with duration, average maturities, call it 5 to 7 years, have beat cash 90% of the time by an average of almost 300 basis points per year on a 3-year rolling basis, which is to say, looking at the story 3 years from now back and seeing how returns were, it's likely that having some duration rather than being in cash will win. So core will be king, its total return time, and that includes high-quality investment-grade bonds because, of course, looking at the Bloomberg aggregate, it's about a quarter of the universe.
How do you pair this idea that you're going to get great total return from corporate debt as well as government debt next year with the bond vigilante story and an unsustainable debt profile of the United States?
Well, in 2024, the bond market, fixed income investors understand not much will get done in Washington. But it's in 2025 that the bond market will be looking closely at what's proposed. You could imagine a situation where a president decides perhaps to propose increasing indebtedness. You would expect perhaps the bond market to push back in that case, and there could be some volatility. We would suggest, though, that the bond investor today shouldn't worry about that. For one, it's in 2025. Secondly, because the bond market is in control. So James Carville's idea of being reincarnated, Bill Clinton's former campaign manager, as a bond investor, because you can scare everyone, is something to be thinking about, because the bond market will discipline the fiscal authority.
Enough fixed income. Should we do Ohtani? The really interesting stuff. The fact that he's going to get paid $2 million per season and defer $680 million until 10 years' time. Wall Street Journal's got an amazing story on this. So 680 is going to pay out between 2034 and 2043. So work out what this means for taxes. I'll read this quote from the Wall Street Journal story for you all at home. During the last 10 years, or rather during the first 10 years, he will be subject to state income taxes on his annual $2 million salary in California and wherever the Dodgers play. But by the time he starts receiving the $68 million payments, he may be able to avoid state income taxes by living someplace like Florida without an income tax, or by moving back to Japan.
680, you misspoke.
That's the story. What did I say?
68. It's move the decimal.
68 a season.
Yeah.
68 a season.
Yeah.
So it's going to be 68, Tom. 70 a season. $2 million is going to be paid up front. 68 per season deferred. Over 10 years. 680 million.
Yeah.
That's how the math is going to work. Nuts.
Or does he even move out of the country? I mean, there's other, not shenanigans. That's not accurate to say that, but this is tax planning, isn't it? I would suggest.
Big time. And then the Dodgers get to spend more money on players, right? In between.
Yeah,
what do other teams think about this?
It really helps the cash. Well, I think I said, and Damian Sassower, Bloomberg Business of Sports, was adamant yesterday. This is game changing across all sports. What's it do to Formula One? Who's the guy that won Formula One this year for Christian Horner?
Max Verstappen.
Max Verstappen.
Yeah.
What's he worth after this discussion?
A lot of these guys already live in Monaco, so.
Well, yeah. Well, now they're going to own Monaco.
They've Reggie Jackson
figured some of it out. These numbers.
You got
are nuts,
Dodgers tickets out there? I mean, do you got Dodgers or Blue Jays tickets?
No, I'm a New York Yankee fan all the way.
Oh, there we go. Oh, they have Juan Soto.
They do.
This is, hello, Boston. Come in, Boston, please. Come in.
Mookie Betts, where's he, TK?
Thank you.
Yeah.
Just
over the Dodgers.
You want to chime in here, Lisa, on 1986? You want to just pick it up?
Go Mets.
Yeah.
Tony, good to see you.
Tony,
Presenti of PIMCO. Thank you, sir. Coming up a little bit later on the economy on the Federal Reserve on CPI data later this morning. Lindsay Piegza of Stifel. Your equity market on the S&P just about unchanged on the S&P 500. In the bond market, yields look like this on a 10-year, down 4 basis points. Still sub 420 at 419.49 from New York City. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Yes, it's end of cycle, and that means one of two things. It means a hard landing, or it means that we're going to have some new exogenous shock or driver for positive growth. Okay, the kind of status quo of decelerating growth, falling inflation, typically is not good for equity. So the no landing scenario was always kind of a fantasy. Right now, the first half of the year probably feels more like a hard landing still, and then maybe in the second half we can get a broadening out.
That was Mike Wilson of Morgan Stanley on this equity market and where this equity market is going next year. This is where it is right now. Your stock market looks like this. On the equity market, the S&P 500 totally unchanged, going nowhere. Yields coming in 3 or 4 basis points on a 10-year, 419.49. Dollar a little weaker, euro stronger. In fact, the dollar weaker against most things in G10 through much of this morning. 107.97 on that currency pair, positive by 0.3%. Busy week ahead. Counting you down to CPI just out in about 2 hours' time, followed by the Fed rate decision tomorrow and the ECB and BOE decisions on Thursday. Lindsay Piegza of Stifel weighing in on the Fed, writing this, TK. The market is convinced the central bank is done with rate hikes, with the first rate cut potentially as early as March. However, with the recent head fakes in inflation, at least some on the Fed may not be convinced inflation is yet in a sustainable, orderly, and timely downward trajectory back to 2%.
Timely is a key idea there. Maybe the inertial force of disinflation back to wherever anybody chooses that we should head. Very sophisticated in this analysis is Lindsay Piegzen joins us this morning. Lindsay, thank you so much. And on this moment of inflation, if you will, what I find fascinating is getting the last mile. Let's say we're 3.8. Getting to 2.8 is a whole different story than what we've seen the last months.
Absolutely. The last 100, 200 basis points is always the most difficult. And to your point, it's not just the nominal level of inflation, but it's the underlying momentum of disinflation that the market is really looking for. We want to be convinced that we're on that sustainable downward trajectory. And if we look at the third quarter, with that recent backup and then sideways movement, that's not convincing that we are on this sustainable, timely trajectory back to 2%. So my concern is the longer the Fed remains on the sideline and slow plays inflation, the bigger the risk the Fed will have to come back in and take further action and maybe slow the economy more than they would have otherwise needed to if they'd simply dealt with inflation the first time around.
Let's get into it. Where are the improvements coming from over the last 12 months? Where have they come from?
We've seen some widespread improvements in terms of inflation. It's moved over from the goods side into the service sector, widespread. But again, a lot of that downward momentum, a welcomed gauge as we move into the key holiday spending season, is from energy prices. And so when we talk about the reversal there, that's probably not a long-term sustainable trend. We could see bounce back up in the first quarter, again, forcing the Fed's hand maybe to take further policy action.
One thing we've asked regarding the Fed is how much of the improvement in inflation is down to the Federal Reserve and how much of that is just a natural rebalancing of the economy. It's come from the supply side. I know it's tremendously difficult to gauge, but if we're going to talk about the prospect of higher interest rates from here, we also have to understand what higher interest rates have done so far over the last 12 months. What have they done?
I think the Fed can take responsibility for the improvement that we've seen on the demand side, certainly not the supply side, not the good side of things, as you talk about the recalibration in the aftermath of reopening the global economy. But on the demand side, we have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace. So that loss of momentum, I think we can attribute to the Fed. But clearly, they haven't done enough to see below-trend job growth, to see below-trend spending activity, and certainly not enough to get that prolonged period of below-trend top-line activity to ensure a return back to stable prices.
Just wait, that's Mike Wilson's message. And what we hear from certain executives like that of Hasbro seems to be something similar. They are seeing a deceleration in consumer appetite. We heard the same from Walmart. How do you pair that idea with some of the recovery that you're seeing in services and other areas that you think could fuel inflation again next year?
Well, this is the big concern. Do we wait on the sideline and hope that inflation slows? Or do we take further action to ensure that prices slow? And from my point of view, I don't think the risk is that the Fed tightens too much, but that the Fed doesn't tighten enough and allows inflation to become further entrenched. And this is really the mistake that they made on the front end. If we go back to the initial start of the tightening cycle, they held on to that transitory language too long. They allowed inflation to become too ingrained, and we're now trying to deal with, particularly on the wage side, these ingrained levels of price pressures that are complicating this process to get us back to 2% inflation.
What should they look for to be confident that they can start easing?
Well, one, a downward sustainable trend. This back and forth sideways movement doesn't instill confidence. But second, we need to see broad-based improvement in some of the most sticky components, particularly wages. And last Friday's employment report didn't give us that confidence. We're still talking about 4% annual wage growth. We have come down from peak levels, but that's not enough to suggest that we've done enough in terms of tightening.
On behalf of 331.9 million Americans, can you explain the USDA, the Department of Agriculture, tells us in October we had 3.3% food inflation. No one is experiencing that. Food inflation is just shocking at the grocery store, at restaurants. John had a $68 steak the other night, whatever. But the answer is the reality. This is what I get 24/7. The reality of inflation is totally different than the verbiage of people like you? What's the divide here?
Well, I think a lot of the differential is the wholesale prices versus what we're experiencing as the end consumer. Because we're not going down, we're not buying the fish at the market, we're buying the fish at the restaurant or at the grocery store. And that is the pipeline of price increase that the consumer is feeling. And so 3% food inflation, no, we're not feeling that. We're feeling more like 15, 20% food inflation. But from the Fed's perspective, again, they're looking at the broad-based components of inflation that regardless of where in the pipeline they want to look, we're still above 2%. We haven't gotten back to price stability.
Right.
There's more work to be done despite the market's consistent overreaction and constant calling for rate cuts. Fed officials are still talking about reaching that sufficiently restrictive level.
The Bloomberg Financial Conditions Index, the Goldman Sachs Index, somewhat the same, all show accommodative structures right now. Part of that is a buoyant stock market as well. Into this meeting and with this report in 90 minutes, are we restrictive or accommodative now?
Well, that's the question. Are we really as restrictive as the Fed thinks? Have we reached that sufficiently restrictive level? And some of these indices say, no, we have not done enough. And when you look at growth...
So are you talking about a rate increase?
I think it's not out of the realm of possibilities that we see a further rate increase. If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase to convince the market that 3 is not the new 2. Orange is not the new black. We have to get back to 2% inflation, and they will not tolerate an above-trend level.
Why is 2 so important?
Because that's the balancing level of inflation that allows the economy to continue to accelerate without moving into a hyperinflation scenario, but also keeps the economy afloat and avoiding the deflationary scenario. So it's a delicate balance that the Fed is trying to walk. And we don't have to pinpoint exactly 2% inflation. Remember, it's the longer-term average. So as we fail to reach 2% for the better part of a decade going into the pandemic, arguably the Fed may be willing to tolerate slightly higher inflation. But again, it's about that downward trajectory of momentum that we haven't established.
I just wonder if we become too focused, Tom, too myopically focused on this 100 basis points. I remember from the other side of it, at 1, searching 2, and all the effort that global central banks went to try and get inflation up, Tom, 100 basis points, whether the effort required to get us down from 3 to 2 would be equally damaging in a different way.
There's been a lot of study on this, starting with Blanchard and Stiglitz at the IMF off of 07, 08, and of course it's been rekindled 3 or 4 times forward. Olivier Blanchard's book last summer addresses directly linked into fiscal policy. And the answer here is, how much work does it take? And the answer is no one knows. And the other answer is it's got to have a price. It's got to have a cost at some point. To me, Lindsay's job is to aggregate everything that's out there. And my answer is we're a disaggregated America. We've got a haves, technologically laden. They don't care about inflation. They're off skiing somewhere.
Who's that?
Pine Tree, Vermont.
Federal Reserve officials.
You know, they're off at Pine Tree, Vermont, wherever. The rest of America's flat on their back.
All right. I'm not going to say anything.
Oh, right. I thought you had something to say.
No.
Okay.
I'm just sort of, we can move on now.
Okay. You want to move on now? You've been going skiing. Is this about you?
I went skiing this weekend. Okay. Yes, it was the first skiing of the weekend. That's what that was about.
Why am I missing the inside jokes this morning?
Because you weren't here yesterday. See what you missed?
You missed us singing White Christmas.
Was he trying to bully you? We're going skiing.
Look, it was great. I enjoyed it. I'm feeding into the, consumption of America.
Good
Keep
for you.
this economy strong.
That America. Nice. Lindsay, thank you. That was a clinic.
Thank
it
you
really was. Thank you very much. Lindsay Pieksa there of Stifel. I'm out of the loop this morning. Equity futures on the S&P 500 totally unchanged. Emily Rowland of John Hancock Investment Management coming up shortly. US CPI 94 minutes away.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going